Don't interrupt me, man. I'm trying to tell people how to make money.
Okay. Come on, let's make some money, guys. Because the last time I was with you, you called the fund that I was doing a pussy fund. Can I interrupt you one more time, though, just so the audience knows? First time I meet this guy, he says to me, I am your senior, though. And,
it's your podcast.
And so Gary
your fans.
Gensler, Gary, huh?
Your fans,
yeah,
your
Gary
audience,
Gensler,
your podcast.
They want to hear you, not me. But what message do you have to the degenerates?
My message is,
guys, Michael Saylor is an American entrepreneur, inventor, and Bitcoin advocate, to say the least. Okay, co-founded MicroStrategy 1989, served as CEO until 2022, and now executive chairman. MIT graduate, Saylor pioneered business intelligence software and amassed a personal fortune exceeding $4 billion. He's going to be in our studios today, and this interview is whack. This cat has accumulated 460,000 Bitcoin. I got that close to him telling me how much he added today when it hit $94,000. Look, we're going to be talking today about some of these other Solanas, the Ethereums, the Ripple. He tells me at the end of the interview if they're going to make it or not, okay? When does he have to liquidate? I think the answer is going to shock you. We had a bunch of people live watching while we were running. Interview was phenomenal. I'm going to tell you something. I've interviewed some of the biggest players in the world. This guy that's going to sit in that chair is one of the most difficult interviews I've ever done in my life, okay? The amount of, first of all, his vocabulary is sick, okay? His understanding of the financial markets is ridiculous. I've been with him 5 or 6 times. I'm starting to just catch up with him. I'm going to try to get my questions in. I offend him on multiple times where I had to cut him off so many times. We almost got in a fight. Again, stay all the way to the end of the interview. Thank you so much for being here. Make sure you hit the notifications. I'm gonna do more interviews like this. Also, he's gonna be going to the Middle East and he's coming back and he's trying to drop by our 10X Wealth Conference. So if you're gonna be in Miami, December 12th and 13th, make sure you get here. Family offices, RIAs, personal finance, financial consultants, financial coaches. If you're in the wealth space, a family office, you run a family office, and you're looking to see what the wealthiest of the wealthy are doing to reduce their taxes and create generational wealth for the next, for immortality. We even talked about immortality and church and religion today, okay? Make sure you come see us at our wealth conference. Until then, enjoy this interview with Mr. Michael Saylor. What a day to be doing this interview.
Yeah.
Huh? Perfect time. Michael Saylor, appreciate you taking time with me. We've met a couple of times now, and really, inspired by everything you're doing. Today, Friday, what's the date today, guys? You probably know the date, huh? we got Bitcoin down to 94.5. What's your
buying opportunity?
It is?
Buy the dip.
Yeah. What did you buy some this morning?
I am. I'm buying.
We
have bought Bitcoin every day this week.
Every day? Every day
this week. And we normally report our Bitcoin purchase on Monday morning. So on Monday morning, we'll put out the announcement.
Uh-huh.
But
is it a lot?
Yeah.
so Mike, when you're a public company, you can you not say that day? Or are you restricted and you have to say it on Monday? Or could you tell me today?
No, I have to tell you on Monday.
Okay.
We do it every Monday. That's our cadence before the market opens. And we file an 8K. And in the 8K, we'll tell everybody exactly what we bought, what we paid, and how we funded it.
Yeah.
So we like to be precise about those things.
Yeah. And so, look, I met you back in January. I think my brother brought me over to your house. And I didn't really know about the Bitcoin thing. I'd been studying. I got some 13 years ago, and I dabbled a little bit. And I asked you about mixing this with real estate, and you've given me some great advice. You've been a little sharp with me every once in a while because I think you get tired of dumb questions, right? Does that happen? Do you get frustrated with people that are new to the space and they're asking you questions? You're like, don't you get this?
You get, it depends upon the time of the day. If you've been talking for 12 hours, then you can get a little bit tired by the 13th hour. So you catch me in the morning.
Yeah, is the morning's the better time? Because the last time I was with you, last 2 times I was with you, one, you called the fund that I was doing a pussy fund.
I just suggested you should put more Bitcoin in it.
And I do it. And we went from 85 to 15 to now we're like 1/3 debt, 1/3 real estate, 1/3 Bitcoin.
Really?
Do you think that's aggressive enough?
I think the point that I'm making is you search the entire world for a good idea. And there aren't that many good ideas, right? I mean,
agree.
Apple was a good idea 20 years ago, or Amazon was a good idea, and Bitcoin is a good idea. And a good idea is something that could 10 to 100x its money. So if you think about all of the things you discovered in the last 30 years that could increase by a factor of 10x or 100x, maybe 10x, and by the way, Bitcoin is 10x in the 5 years since I got in the business, but think about all that and then ask yourself the question, should you put 2% of your money into a good idea? Are you going to have 49 other equally good ideas? Okay, you can put 10% of your money. If you put 10% of your money into an idea that, 10x is you double your money. But of course, is everything else, does that mean that you're going to put 90% of your money into a not good idea? So my issue there is, if I think about my history as an investor, my number one regret is if you found a good idea, you wish you had bought more.
Right, that's right, always.
And you wish you'd never sold. Mm-hmm. So if I can spirit you back 20 years and give you the chance to buy Apple or Amazon or Bitcoin.
Which I didn't buy any of those.
Are you going to give advice to someone they should put 2 or 3 or 5% of their portfolio in? It's like, I think if you're going to do it, you should put in an amount of money that changes your life.
Yeah.
So, well, look, if you're diversifying and you find a brilliant idea, maybe you put 5 to 10% of your wealth in it because you want to stay diversified. But, Jeff Bezos didn't get rich by having 5% of his assets in Amazon and selling 95% of his Amazon stock as soon as he could, right? So Steve Jobs,
I think he had 2
Larry
stocks
Ellison, Mark Zuckerberg, Jeff Bezos, Elon Musk, Bernard Arnault, they don't get rich by selling 95% of their good ideas and keeping the last 5, or by selling 90%. So I just think when you find, if you're pitching someone a digital real estate fund,
yeah,
and if real estate's going to go up 7% a year and Bitcoin's going to go up 30% a year, then you don't want it to be 10% Bitcoin and 90% real estate. It's just a little bit better than everything else in the world. Why not put it half and half?
Yeah.
And then why don't you deliver 20% gains a year when the entire rest of the real estate industry gives you 7%? Because if it's a bad idea, it ought to be 0 and 100% real estate.
Yeah.
And if it's a good idea, then you might as well go 50-50,
right?
Because that way you're giving someone juiced real estate 3 times as good as every other real estate investment in the world. I think if it doesn't work and you put 10% of your money into it and it doesn't work, then you just had a dog real estate fund and it failed, right?
Yeah.
So when you have an idea, you either think it's going to work and you might as well put in enough such that you win and everybody gets rich, or don't do it at all. I'm not a big fan of that. I'll give you one more example. I use, Rockefeller invents kerosene.
Yeah.
Kerosene is the most highly distilled form of crude oil. And it's jet fuel. It's rocket fuel, right? It's pure liquid energy. Okay, so a good idea is I build a rocket. I build a rocket ship, I build a jet engine, I build a jet airplane, or maybe I create gasoline or diesel and I give you a car or truck. Those are all good ideas. Henry Ford, Boeing, they did that. What's a conventional idea, a safe idea? I put a kerosene lamp in the back of my horse and buggy.
Right.
And I tell all my horse and buggy customers that now they can read a book while they're in the horse and buggy crossing the nation. Or I put a kerosene heater in the back of the buggy because my customers complain about it taking 30 days to go across the Rockies in a buggy, and so I heat them up. And my point is, you don't really want to be the dude that's 2% invested or 3% invested in the revolutionary idea. You want to create the rocket ship. And so in that case, I feel like either don't do it
Yeah.
Or do it in such a way that it's so much better than everything else in the world that everyone will sell everything else and buy your thing, and everybody, lives happily ever after. So that's my view.
Where do you think the diversification, who sold the diversification to America and to the world? The idea to go into, just send it over here, to an ETF or a mutual fund.
It's a classic thing. I think when you don't know the answer, when you have 100 choices and you genuinely don't know the answer, and you're in the business of selling a diversified fund, you pitch in diversification.
Right.
So I think partly the Vanguard 500, John Bogle, and then conventional finance people. But
that's $11 trillion sitting over there. It's done very well for them, but I don't know that it's done that well for the American
the world's full of hedge fund guys that created diversified portfolios, and their pitch was, no one decision we make is going to bankrupt you, so give us all your money.
Right.
But if you actually look at the results, they underperformed consistently. The king of diversification is just to buy the S&P index. But generally, I think that there's a distinction here between the financial statisticians that want you to give them your money. For them, diversification is a good pitch because, hey, you're a retail investor or you're busy, and I'm going to protect your money by investing you in 27 uncorrelated diversified assets, and I'm going to rebalance the portfolio every month. And I'm going to have 50 analysts that rebalance the portfolio, and I'm going to charge you 2% fee and 20% of the upside. And my my value added is consistent dynamic diversification. So that's what they're selling, and they want you to believe that you need them, and they charge you, when you charge 2 and 20, you're basically taking 40% of somebody's capital over the course of 10 years, right? So it's pretty expensive service. On the other hand, there's another view of the world, which is the engineer's view of the world. When you build an airplane, you've got the choice of building an airplane in copper, aluminum, or steel, or bronze, or bricks, or wood, and there's a right answer, aluminum, and everything else is the wrong answer. And if you build it in steel, it doesn't fly. And if you build it in clay, it doesn't work, right? You build it in copper, it's not working. So in engineering, there's a right answer for the plane. It was aluminum. For bridges, there's a right answer. It's like steel, right? When you're creating a window, there's a right answer, for how what kind of glass you use, and then there's a wrong answer. So engineers are used to asking the question, what's the right answer? How about you want to conduct electricity through a line, copper, or titanium, or you can pick 100 metals, but there's one metal that works better than the other metals. So if you're an engineer and there's a right answer, you don't diversify, you pick the solution, because otherwise you die. But when you don't know the answer, when you're not sure whether copper's going up or aluminum's going up or steel is going up or a bushel of corn is going up in price, and nor does your customer know the answer.
Pick them all.
Well, you can create a service, which is I'll just give you a diversified mix of all of them, and that justifies your business and you charge a lot of money for it. But, I think that diversification only makes sense when there is no right answer. It's like the joke example I use is, you're on a sinking ship and there's 10 lifeboats, and one of them, is watertight and the other have holes in the bottom of them. Find the one that's watertight, put the entire family in that one, and then you live, and pick the one that isn't watertight. You're going to die, right? You're not going to diversify across a bunch of imperfect components.
Were you looking 4 or 5 years ago or before that? Were you looking for something other than what you were doing?
During the COVID lockdowns in the middle of 2020, we had $500 million of cash, and the bankers took the interest rate to zero. And we were
500.
Yeah,
$500 million in cash.
$500 million. And, so it's like you have a $500 million real estate portfolio and the mayor of the city unilaterally reduces your rents to zero and tells you they're going to rent control the rent to zero for the next 5 years because that's the right thing to do because we're in a crisis, right? There's COVID crisis.
Yeah,
and if you don't like it, then you must not be a good citizen, right?
Right.
There's something wrong with you, right? You're just insensitive capitalist. And the right thing to do is we just reduce the rents to zero forever, which is easy to do with somebody else's money, right?
Yeah.
So that's kind of what happened during COVID, right? I mean, we literally did it with rents.
Yeah, yeah.
You know, and we did it with capital. So when that happened, if that were to happen to you, if someone said, I'm reducing your rents unilaterally to zero forever, and you could sell the property and move to a different state or move to a different city, you might very well do that, right? So we had $500 million worth of property. It was called Treasury bills. It was unilaterally reduced to a value of zero per year. And I think Jerome Powell gave a speech, and he said very famously, he said, we're not even thinking about raising the interest rates until the year 2024 or 2025.
Right. Repeatedly he said it.
I didn't need to hear that twice. So I thought I better go find something else to buy other than Treasury bills. So we started thinking, could we buy a stock portfolio? Could we buy a portfolio of art? Could we buy some real estate? Could I buy a fraction of a sports team? Should I buy a bunch of gold, or should I buy a bunch of digital gold? And by the process of elimination, we went through all those things.
Had you been introduced to Bitcoin prior to that?
No, not really.
Okay.
I mean, I'd never really seriously thought about it.
Okay.
Right? So I went through the process of elimination, and I started thinking maybe I should buy gold. But then I thought what I'd really like is something that feels like gold, a non-sovereign store of value bearer instrument, like, you know, and I like something which is the best cross between gold and Google. I wanted a digital monopoly on money. Digital gold. And I thought, well, this crypto stuff looks like it's digital gold, a crypto coin, 21 million crypto coins, because the appeal of gold is it's scarce and desirable as a store of value. And the appeal of crypto is I can teleport it, and I can self-custody it, and I can program it. So then I just started thinking, well, what's the crypto network which is most like gold? And I eventually decided Bitcoin was digital gold. And so we bought Bitcoin because, gold was the best idea of the 19th century. And arguably, if you wanted portable capital, you wanted portable property, you wanted money for the past 5,000 years, right? Gold was generally a pretty popular idea. But in the 21st century, what you'd like is something that's as desirable as gold, but you want it to be programmable. You want to move it at the speed of light. You want to put it on an iPhone. You know, and the thing about Bitcoin, which is better, in addition to being programmable and digital, was that it's absolutely hard capped at 21 million coins. And so the inflation rate of Bitcoin is zero. It was pretty obvious to me over the long time horizon. As the limit goes from zero to infinity, the inflation rate is zero.
Why is it zero?
Because there's 21 million. That's all there's ever going to be.
Okay, so
there's 21 million.
Yeah.
Right. And the rate at which we create more Bitcoin is asymptotically falling to zero. It's falling to zero.
What is that word?
You know, asymptotically. Asymptotically.
That's a big word, bro.
It's like if I try to go to the wall there, and each time I move, I cut my step in half. And I go half as far and half as far and half as far and half as far. That's asymptotically approaching the edge of the room.
Wow.
But even over 1 billion trillion years, if I keep cutting my step in half, I'll never get there, right?
Yeah.
But on the other hand, you say, well, how wide is the room? It's like 12 feet.
Right.
Well, so with Bitcoin, you know that there'll never be more than 21 million Bitcoin. And in public company parlance, you would refer to that as the fully diluted share count. The fully diluted Bitcoin count between now and 1 million years.
There can't be any more shares.
It's like if you knew you were going to 21 million shares.
Yeah.
It's like when I'm valuing your company, I want to know, well, what's the total number of shares that can ever be issued between now and 100 years from now, right? I don't really care how many shares you issued this week or this month. I just want to know, are you going to 21 million shares? Or are you going to 2.1 trillion shares?
Right.
Right? And so the fully diluted Bitcoin count was 21 million. And the significance of that is that means the inflation rate's 0. But the inflation rate on gold is 2%. And the fully diluted gold account is infinite, because if I keep increasing the amount of gold by 2% a year, that's infinite amount of gold. If you want to figure out practically how you value it, well, when you increase the supply of something by 2% a year, that means that you're doubling the supply every 36 years. That means the economic half-life of your money is 36 years. That means the half-life is 36 years. That means you're going to live 70 years. Okay, well, what's the half-life if the inflation rate is 0? Infinity. So what's your life expectancy if the inflation rate is 0? Your life expectancy is infinite. You're immortal. You're living for 1 billion trillion years.
Like that idea.
0 is 1 billion trillion years. You're a god. 2% is you're going to die, half of you dies in 36 years, the other half dies in the next 36 years. Maybe you make 100 years and you're pretty much done for, right? And so it's the difference between a mortal life of a human being versus economic immortality. We can dismiss it if we just think in the next 12-month time frame. But, if you're an engineer, it's like, well, what's the difference between you lose 2% of your energy every cycle versus you lose none of your energy every cycle? None of your energy every cycle is perpetual motion. You last forever. 2% of your energy every cycle, and you spend it 100 times, there's nothing left, right? You burn out the motor. Okay, so I like the idea of gold, but digital gold is better. And how much better? Infinitely better, right? Infinitely better. So in 2020, we settled on Bitcoin as digital gold. We decided we're going to sell our $500 million worth of Treasury bills, and we're going to buy $500 million worth of Bitcoin.
First purchase was how big?
$250 million.
Wow, dude.
Next purchase, 2 weeks, 3 weeks later, 20 days later or something, was $175 million.
Your first purchase was $250 million. Half of your cash reserves.
Yeah, well, actually,
how did
I would have bought it all, by the way. I wanted to buy it all, but the board of directors wouldn't let me.
Well,
like my
bunch of idiots, huh?
Yeah,
I said that, you didn't. But let me ask you, how do you make a decision after years of accumulating that much fiat, that much cash?
Yeah.
How do you make a decision in a week, I'm going to drop $250 million, half of my reserves, into one investment? How do you get that much conviction that quick? Or did it take a minute?
The lockdowns hit. The politicians make us close the office. Everybody goes home. Google and Apple and Amazon and Microsoft start sniping all of our employees from home. It's pretty clear, right? If I want to destroy your company, I sentence all of your employees to home jail, right? To home imprisonment. And then I offer them 20% more to redirect their computer browser to some other company. So it's clear we're going to lose all of our human capital. The stock tanks to $9 a share, and the company's worth nothing.
This was MicroStrategy at the
2020.
time? Yeah.
Yeah, I'm telling you the story of You're asking me, how did I get conviction?
The audience, your software company.
It's March of 2020.
Okay.
We're a software company. Yeah. We're a $500 million software company. And the lockdowns come, and all of our employees get sent home, and we're losing them to Microsoft and Amazon. And so we're losing our human capital. We're a public company. The stock tanks, it's valued at half of revenue or something.
Wow.
Call it $3 a share. That's what the company's worth. And if we do, and then Jerome Powell says, well, the $500 million in capital, that's worth nothing forever.
Wow.
And our choice is either sell the company. It's like a fast death. Just sell the company, give up, write off 30 years of work. Or a slow death, cling on to $500 million of cash yielding 0, watch it get inflated 20% away a year, right? The inflation rate was 20% at that point. We're printing money like there is no tomorrow. Costs are, you can't see the inflation in 2020 because it's illegal to buy anything. Right? When there's a war and the government doubles the money supply, but it's illegal to buy anything, you don't see the inflation. You see the inflation after the war ends, when when you can go buy an airplane ticket or go to a concert or go try to go to a hotel, and at that point everything doubles or triples in cost, except you don't have any money, right? Because the government doubled the money supply. So it was pretty clear to me that that the currency was collapsing, and we were going to have all our human capital stripped away, and we were, having all of our financial capital stripped away. And, I think the stock traded $1 million a day. Like no one cared at all about the company. And we're either going to basically sell the company, give up for, $8 a share, $10 a share, whatever, or we're going to cling to life for 5 more years, at which point all of our employees will have quit. The product won't be any good anymore. We've just had all of our talent stripped away from us, and then the world will say, well, they went out of business because they deserved to go out of business because they couldn't compete with the big guys, Or we could do something. We could take a risk. So it's that point in the movie where the guy's sitting in the Citadel with an army, and he sees there's a war, and there's the War of the Roses, and there's there's the white faction, and there's the red faction, the Yorks and the Lancasters, and you're either going to sit there and get starved to death by both of them, or you're going to pick a side, and you're going to ride out and you're going to fight, and if you win, maybe you get to live, and if you lose, well, at least you went out fighting, right? And so that was where we were at in 2020, and we decided it's either a fast death or a slow death or fight. And I thought maybe I would prefer to fight.
So you thought at that time, buying $250 million worth of Bitcoin in one day. Had you bought any up to this point at all?
No, I mean the way we got there.
Bitcoin?
No, nothing.
Nothing.
No, I mean,
crazy.
Look, it didn't happen in one day. What happened is I concluded by April that this was a way out. Bitcoin was growing 80% a year at the time. Mm-hmm. So if you can buy something appreciating 80% a year, that's a commodity on your balance sheet.
Faster than your company.
It's like, if you could buy a digital monopoly growing 80% a year at 1 times revenue, would you?
Yeah.
Of course you would.
Yeah.
If you could buy a digital monopoly growing 30% a year for the next 20 years at 1 times revenue, would you? Everybody would. It's not a complicated idea. I expect Bitcoin to grow 30% a year for the next 20 years. It's a monopoly. You're getting it, you buy $100,000 worth of Bitcoin, you're getting a $100,000 business growing 30% a year. That's a monopoly at 1 times revenue. Why wouldn't you? Everybody would. The breakthrough was just thinking of it as doing a acquisition of a digital monopoly on money, right? It's the dominant digital monetary network, right? So we have to do a transformational acquisition. And
to survive.
And since there's no other company growing 80% a year that's available at 1 times revenue that'll sell themselves to us, Bitcoin was the deal, right? Bitcoin
no
was
employees.
So we looked at it and we thought we can buy the dominant digital monetary network at 1 times revenue. It's growing 80% a year. On paper, it looks just fine. It's just no one ever done it before. But the theory isn't that complicated. I mean, what did Facebook pay for WhatsApp or for Instagram?
WhatsApp, yeah.
WhatsApp. I mean, what did Google pay for YouTube?
Yeah.
Okay, so it's not a complicated idea. You buy the monopoly, something that 1 billion people need, nobody can stop, that's in hyper growth mode, that'll sell itself to you cheap. Why wouldn't you?
Yeah.
So that wasn't the problem. The problem was no public company had ever done this before.
Right.
And so first I have to convince the officers of the company. Then I have to convince the board of directors of the company, right? Now, and that takes a while. And then the logical thing is, let's just go ahead. We're going to bet the company on this, buy 500 million worth. But, between the lawyers and the risk managers, everybody thought, well, that's too risky. So let's do I said, well, what about 400? I'll do a buyback. 400 million of Bitcoin, I'll buy back 100 million of stock. No. 350 million of Bitcoin, I'll buy back 150 million of stock. No. 300 million of Bitcoin, I'll buy back 200 million of stock. No. Okay, here's my best and final offer. 250 million of Bitcoin, and I will buy back $250 million of the stock in the open market, the tender offer. Okay.
So explain that to me. So
when we announced the deal, what we said was, we're going to buy 250 million of Bitcoin.
Yeah.
And we're launching a tender offer. The stock was $120 a share. We'll buy you out at $140 a share if you don't like the idea. So we basically said...
And who funded that?
The company. The company had $500 million.
Got it. Okay.
And the company said, we're going to buy
I'm a real
back.
estate guy. You got to remember, I'm a real estate guy, dude. It's like, to us, it's like, I got to see it, I got to touch it, I got to feel it. So you got to go slow with
I'm
me.
the CEO of a public company.
Okay.
And I want to do something very risky.
Got it.
But you're the outside shareholder, and you think I'm crazy.
Right.
So I say to you, I'm going to go bet the company on Bitcoin, but if you don't agree with me, I'll buy you out your shares.
Got it. Got it.
And so I'm going to offer you $140 a share.
$20 premium.
Yeah.
Yeah.
If you want to get off the ride.
How many people took you up on that?
So the way it worked is we announced the $250 million in Bitcoin. Then we had a 20-day tender period. We made a tender offer. We offered to buy up to $250 million. The stock traded up, and then it traded above the $140 price. And everyone that didn't like it sold into the open market at north of 140.
Wow.
When the 20 days finished, we had $60 million worth of shares tendered. We paid off the $60 million of shareholders at 140. We had about $175 million of extra cash at that time. We turned around and bought Bitcoin with that. So the first deal was 250, and that second deal was after the tender offer. It was the extra 175 million, and then Bitcoin rallied, the stock rallied, ran through the roof, and the rest is history.
So Bitcoin was what price then? Do you remember? I'm sure you do.
When we did the first deal, we bought Bitcoin, and we bought it at like 11,800. Okay.
Now, do you just bang the bell, right? You just hit it?
No, then immediately Bitcoin crashed down to 9,600 or something, and we lost $40 million in the next 2 weeks.
Oh my God.
And so
what's going on for you when that happens? Because that's what happens every time I buy it. It drops 20%.
It's an instructive story because the point is it was never easy. It will never be easy. And if you were buying expecting to get an immediate risk-free return in the next 2 weeks, you have the wrong attitude. So we bought it. The price crashed. We went through with the tender offer. We got 175 million, and we went and we bought the next tranche at 10,200 or 10,300. So we doubled down after the dip. And then it turns around, flies through 12,000, runs to all-time highs of 19,000. The stock 10x's.
Yeah.
All the stock options get exercised. We get another wall of money. We buy another $50 million worth.
Where's the wall of money come from? Explain the wall of money. It sounds sexy.
All the employees had stock options. And the stock options were, sorry, let me just adjust my cushion.
No, please, help me.
The stock options are, struck at whatever, 190 bucks, 80 bucks. This is pre-split. The company eventually split 10 to 1. So if these numbers seem different to you, that's because we split it 10 to 1. But so the stock options are whatever, 80, 90, 100, 110. When the stock's trading between 90 and 120 during the lockdowns, the stock options are worthless. When we bought the Bitcoin and Bitcoin rallied, the stock went through the roof, rallied up to 200, then $300 a share, then $400 a share. When the stock rallies, all the employees exercise the stock options, and the company gets an avalanche of money from stock option exercise.
Got it.
And so all of a
they're
sudden,
buying the shares at 110.
No, the employees are selling the shares.
They're selling the shares.
They're selling the shares at 400, and they're exercising the option, which means they're buying. They're buying the stock at 110, and the company's getting...
Got it. The company gets the 110.
Yeah, so the company generated a lot of stock option income because the stock took off. And so we bought another tranche of Bitcoin. And the volatility spiked, the liquidity spiked, the stock went through the roof, and by December of that year, we were able to do a $650 million convertible bond offering at 75 basis points interest cost. So basically free money.
Yeah.
So someone gave us $650 million of free money by December, and by February we did a $1 billion deal at 10x. The strike price was $1,400 a share. Remember, the tender offer was $140 a share.
Right.
So we did a convertible deal at 10 times the price of the tender offer, maybe 6 months previous, or the tender offer was in September. So
can you hold that? Can you hold that thought? Where did you learn the financial engineering part? Like, I know you're an engineer by nature, okay? You're a very intelligent guy. You studied history. But where do you, every time I'm with you, dude, I'm just like, where did you start seeing this? Did you look a lot? Did you study?
I took the company public in 1998. And so I'd been a public company CEO for 22 years by the time we went into this.
You were how old?
Well, when I took the company public, I guess I was 33.
Okay.
Yeah.
Jesus.
I started the company when I was 24.
Yeah, okay.
So I started when I was
wow.
in 89. I was 24, and then we were a private company from 89 till 98. And at 33, I took the company public, and then I lived through all sorts of.
You went the IPO route.
Yeah.
The route. What do you call that? The rite of passage.
I guess you could call it
that's what
that.
you told me it is.
Yeah, and I'd had experience as a private investor, and so I invested in all these big tech stocks, and I made fortune. I made a lot of money investing in Apple and Amazon, like 20x my money in all the big tech things, and I had a vivid recollection that I'd worked myself to death, like 3,000 hours a week for 10 years in my business, and I couldn't get ahead. We were basically banging our head against the wall against Microsoft. But 1 hour a month, I would invest in Google or Apple or something, and I was making a fortune, and it was easy. And I started thinking, if I had it to do again, I think I'd take the company money and invest in the big tech stocks, because then the shareholders would all get rich, because simply working harder to compete with Microsoft is not a way to get ahead, right? They're just too powerful. You cannot compete against the monopoly of the world. So I had that experience. I had some experience trading swaps and currencies and other things. So I had an intellectual interest in these things. But really, necessity is the mother of invention, Grant. It's like when someone tells you, I got some bad news. It looks like you're going to die of something. You've got 12 weeks to live. You all of a sudden get religion and you start, you go online and start interrogating the AIs. You start arguing with the AI about whether this is right or wrong. And someone says, maybe you might want to change your diet. And the thing you dismissed for 50 years, you think, maybe I might want to change my diet.
Right.
So I think you get open-minded when you have this near-death experience. And what they say in the history of science, and one of my degrees at MIT was the history of science, they say the only time you ever see a paradigm shift is either when the old guard dies, like people that think they know how the world works just have to die, have to get out of the way. Max Planck said science advances one funeral at a time, right? And then the other time when there's a paradigm shift, when people embrace a new idea radically, is during a war, right? War on COVID, World War II, someone's dropping a bomb on your head, and you're an aircraft denier. You don't believe in air power, right? You don't believe in nuclear power, and they drop an atomic bomb on you. Okay, so a lot of things that people rejected. We literally court-martialed Billy Mitchell, right? Like the military court-martialed the guy that said, the Air Force is important and airplanes are important. Yeah. The Army court-martialed him, right? I mean, Pearl Harbor.
COVID was a war.
What?
You think COVID was a war, or equivalent to a war?
It's absolutely a war.
Yeah.
There are 2 wars going on.
Yeah.
Right? Maybe 3, right? There's a war in COVID, technically, right? That biological war. There was a cultural war, right? There's a cultural war. The war when we shut down every small, mid-sized business and bankrupted gym owners and restaurateurs and bar owners and everyone that worked with their hands in the blue-collar labor 100%. While we enriched Wall Street and hedge fund managers, right? Everybody on Wall Street had the best year of their life, and everyone that actually was a blue-collar laborer, not only were they bankrupted, they were thrown in jail for showing up to work. Right? Had their reputations destroyed, their accounts frozen, et cetera. There's definitely a cultural war there. You still can't talk about it, right? Right? It's still very difficult to talk about. And then you had a currency war, a war on the currency, right? When you basically determine that the interest rate is going to 0, you're inflating the currency through the roof. You're devaluing someone's assets, right? I am devaluing your currency. And of course, all of the derivatives of the currency. So there was a currency war as well. And if you didn't notice it, right, you must have been in a coma for the year. I think everybody noticed it. And the issue is, how did people react to it, right? And everybody's got their own story of how they reacted to it. But I think it was pretty transformational to a lot of people in the world.
So this is COVID. Your business is suffering. You're losing employees. Did you lose a lot of employees to the big guys?
Yeah. I mean,
how many employees did you
well,
have?
I don't have the exact number, but
No, but I mean,
but when someone's got $1 trillion, they're not offering less money to the employees they're hiring away than you're paying, right?
And they could stay home.
Yeah, so we were losing our employees. We're having our talent stripped from us. The business, as I said, it was either a fast death or slow death that you fight. So we just decided we were going to fight. And
when did you know you were right? How long before you're like, okay, this is going to be a new industry, not just a surviving business?
By October of 2020, we launched that tender offer August 10th, August 11th of 2020, and made the second buy in September. And right around the time that PayPal announced support for Bitcoin, and then when Square came out and they bought Bitcoin, and then Bitcoin rallied into the teens and ran toward the all-time high, and our stock rallied, it was clear we'd saved the company. And it was a gambit that had worked out. When
did you know you were creating an industry? I mean, obviously,
what happened was our journey was, we started out of desperation and frustration, right? I would say Q2, Q3 was desperation and frustration. You fight or you die. And then I think we moved into opportunistic phase. It became opportunistic. Hey, someone will give you $1 billion for free for 7 years to invest in your business. Do you want the money? Of course I want the money.
Yeah, of course.
Right? Okay, so it became opportunistic, and then at some point we realized there weren't very many public companies. Being a public company that's a well-known seasoned issuer with an options market that can actually issue bonds and sell equity to buy Bitcoin made us a very unique creature, so it became strategic, right? There are a lot of people I meet even today, and they go, well, I had money locked up in a 401k back in 2020, and I believed in Bitcoin, but I couldn't buy any, and then you came along, and so I could buy your stock, and I made a fortune, right? People in the UK had money locked up in a retirement account. People in the US, but a lot of people, they could buy an equity, but they couldn't buy the underlying Bitcoin. And if you bought our equity, you could use money tied up in a retirement or IRA account. You could borrow against the shares. You could trade the options on the shares. And then we created these convertible bonds. And if
this is 21 now.
Yeah, well, actually starting in 2020.
Okay.
Right? I mean, if you believed in Bitcoin in September of 2020, you can't buy Bitcoin.
I couldn't because
your money's in a retirement account.
And the Merrill Lynch wouldn't allow me to.
Even today, you can't buy Bitcoin from a retirement account.
Oh, really?
5 years ago.
Oh, I didn't know that.
Go try it.
Oh, okay.
Yeah, you can't. You can't buy a crypto asset in a regulated retirement account in Australia or the UK or the US. For the longest time. So a lot of people had a lot of capital tied up. Even if your money was freely yours, you would then have to go and set up a relationship with a crypto exchange. That would take you 6 weeks to 12 weeks. Then you would have to wire them the money. Then you would have to buy it. It was very difficult. And even if you did it, let's say that you actually had money that was free and clear and you set up a crypto relationship. So you put all your money into that, but you can't borrow against it. Right? And so we became
virtually illiquid.
We were an institutional on-ramp for people.
Right.
You can borrow against MSTR. You can buy MSTR. You can direct your retirement funds into MSTR. You can. By the way,
you didn't have this story though. In 2020, you didn't know this would happen, right?
No. No, I didn't know.
Yeah, right.
I learned it. It was a fortunate happenstance. A serendipitous development. Right. I didn't know all those things. All I knew was we're going to die unless we fought.
Right.
And so your back is against the wall and you decide, I'm not going to roll over and die. I'm going to fight. What came out later was we became the largest issuer of convertible bonds in the world, and we had the most valuable convertible bonds because they're backed by Bitcoin. And so that was a lucky find. That was worth $10 billion to us. And then it turns out there was no ETF. IBIT didn't exist until 2024. Any Bitcoin-backed ETFs didn't exist. So for 2021, 2022, 2023, 2024, there were no ETFs. And so we were the equity on-ramp for people. And that was another fortunate happenstance. Then it turns out that people, all the derivatives traders, want to trade in the options market. You want to buy calls or puts or whatever. Well, we ended up going from a $1 million open interest to a $100 billion open interest. Okay, $100 billion makes you like one of the 10 biggest options markets in Wall Street. So I didn't know that was going to happen. It didn't occur to me. But because we were a company that had been public since '98, we're a well-known seasoned issuer. So the options immediately came to life. We could issue the bonds. We could do the financing. Our equity became liquid. You could borrow against it. And so we inherited all of the financial apparatus of a Schwab or a JP Morgan or a Morgan Stanley. And we could, our security could be bought in, UK retirement accounts. So we got a bit of a benefit there and a head start by being the pioneer.
Right.
When the ETFs got approved by the SEC.
This year? In
January of 2024.
Okay, last year.
Yeah, when they got approved, they were crippled by the SEC. The options markets on the ETFs were crippled. You could only trade very small amounts of options contracts. And so we still were the dominant derivatives on-ramp and off-ramp for the entire crypto economy, right? Like at one point we were like $100 billion and the next closest thing was 10 billion. So we were 10 times bigger. And
wow.
And our stock was trading 3, 4, 5 billion a day, and that was twice as much as everything else combined.
3 or 4, 5 billion
a day.
Dollars?
Yes. $3 billion.
And
$3 to $5 billion of MSTR trading every day.
And prior to that, what were you trading? Before you
in February of 2020.
Yeah.
$2 million a day.
Oh my God. $2 million
a day. Yeah. We went from 2 million to 4 billion. Yeah, and so even in 2020, though, our equity was trading twice as much as all the other ETFs combined. So we became an institutional on-ramp for equity, for derivatives, for fixed income, for bonds. And that was all serendipitous. So on answering your story, right, we go from frustration and desperation to opportunistic, then it becomes strategic. And one of the things you can do if you're a WIXI, a well-known seasoned issuer, is you can file a registration statement to sell $1 billion of bonds on a Monday, and you can sell them on a Tuesday. You don't have to wait for approval from the SEC.
WIXI is what now?
Well-known seasoned issuer.
And you were well-known?
WKSI, WIXI.
Okay. Well, you're well-known because?
It's literally a legal term.
Okay.
It is the term applied to a public company in the United States that can file a registration statement and sell securities to the public the next day.
But the well-known part is because you're public, because you've been traded, because you have activity.
Don't ask me why they call it that. It's just a legal term. Right?
Okay, well-known.
Well, the legal term is this is a company we know well.
Got it.
It's seasoned. It's been issuing securities for a decade or some long time.
Got it.
And it's an issuer.
Got it.
Well-known seasoned issuer.
Okay.
WIXI.
Okay.
It's a technical term.
Okay.
Right? Everybody's learning something today.
We all learning something, guys?
Well, here's the important something to learn. There's 400 million companies in the world. There's 40 million companies in the U.S. There's 4,000 big publicly traded companies. There's maybe 400 WIXIs. There's maybe 2 to 400 well-known seasoned issuers.
Wow.
So in the entire
you want to be one of those?
Yeah.
Okay.
Yeah. The punchline to this story is,
I'm learning, Michael.
If you can sell $1 billion of security to the public without waiting for permission from the regulators, that's a massive competitive advantage.
Right.
Okay.
So you announce on Monday, Tuesday you're collecting money.
Yeah. And of course, this is a capability we had in 2019 or 2020. But of course, we never had a reason to sell securities. Mm-hmm. Most well-run public companies aren't in the business of selling or issuing securities. They're in the business of buying them back. So the big inversion, right? The paradigm shift, the thing that allowed us to really, you said, when did you become, the leader of the movement or create a new industry?
Yeah.
Right? It's when we realized that if you're a well-known seasoned issuer, you can sell $1 billion a week of securities. If you're not a well-known seasoned issuer, if you're a public company, but one of the smaller ones, you file the registration statement and you wait for 3 to 6 months to get permission.
The whole market.
And by the time 6 months have gone by, it's too late.
Right.
Okay, maybe you'd wait a year.
Right.
If you're not a public company, it's illegal to sell the securities. Then, you might spend 3 years. Mm-hmm. It takes 3 years to take a private company. Yeah, you know a little bit about this.
Yeah.
It's not easy to go from being a private company to being a public company.
Almost impossible.
They make it hard, don't they?
Why? Why do they make it so hard? And then we'll get back into this. But
it probably goes back 100 years.
I don't think it's for the good of the investor, though.
Yeah, go back to 1930s with the SEC Act of 1933. It was a reaction to the 1929 stock market crash, and it was a bunch of guys in Washington, D.C. making a power grab to centralize control of the securities industry in Washington, D.C. and move it away from New York City. Mm-hmm. Depending on who you believe, there are a lot of historians that say this was a triumph of the Rockefeller interest over the J.P. Morgan interest. And they wanted to prevent J.P. Morgan from creating so many companies and exercising so much control. So in the SEC 40 Act, or the SEC 33 Act, they basically said, you have to get permission from an agency in Washington, D.C. before you sell securities to the public. And we might not give you that permission. So, I could talk about that for hours and hours, and there's tens of thousands of pages written on it. But all of it has to do with quote unquote investor protections. And you could characterize it as one point of view, right? The very regressive point of view is I can conceptualize of a situation where some investor might lose money or might be victimized. And so therefore I'm going to prevent anybody from doing anything.
Right.
And then the other point of view would be, I think it's better to let a million businesses do things. And if someone commits fraud, they should be civilly or criminally liable for the doing of everything. But let's let people drive the cars, even though we know there's going to be an accident.
Yeah.
And let's let people sell products, even though some of them may be defective, because the alternative would be to shut down the economy, right? So I think that with regard to securities, we kind of moved progressively. Each crisis resulted in a tightening of the tourniquet, and it got progressively more difficult and more expensive and more risky to sell securities until we got, I think there were 12,000 public companies at the turn of the century, and all of the Sarbanes-Oxley rules made officers criminally liable for every mistake. And we went from 12,000 to 4,000 public companies, and people just said, screw it, I don't want to be public anymore. Yeah. It's too risky, and it's not worth it, and it's just too difficult. And so I would say we reached the low point in entrepreneurism and capital markets by about 2020. And the crypto movement was the opposite. The crypto movement is, hey, why can't I just launch a token in 4 hours for $40?
Right.
Okay, so if you look at it, you say there's 40 million companies in the U.S., but there's only like 0.01% of them that can access the capital markets. In any other industry, if 99.99% of the businesses didn't have a telephone or a website or a truck,
no chance,
or electricity,
yeah,
we would declare it to be a sick,
yeah,
and moribund, stagnating economy.
And you're saying finance is like electricity?
Yeah, capital markets are like that. So coming back to our story, though, the point is we were a well-known seasoned issuer. We had an asset which we had not utilized. We had an undervalued asset, that is a public listing of a seasoned company. And we accidentally discovered that we could use it when you issue stock options to employees and they exercise the stock options, the company generates $50 or $100 million like that. That's a public company benefit. And then when you sell $1 billion of convertible bonds, that's another benefit.
You're finding literally money's dropping out of the skies at you.
Yeah, and then we discovered a new thing, something that Michael Milken had created many, many years ago called the at-the-market offering, a shelf registration. And the idea was you file a shelf registration with the SEC, and then on any given day, you can sell the shares into the market on the same terms as every other investor. Okay, that didn't exist when I came public, but what that means is you file a $1 billion equity ATM. The company says, from time to time over the next 3 years, we may sell equity. And if the equity is trading strong in the market, you can go and sell $1 million of it, maybe 10 million, maybe 100 million. We had days where we sold $1 billion of it.
So you explained to me the ATM. Now you're going to sell $1 billion worth of stock.
We sell $1 billion of stock. We take the billion, and then you do something with it. You can invest it in real estate. You could buy gold with it.
In your case,
bought Bitcoin with it.
You were buying Bitcoin.
Okay, so we didn't know about that, and it's not something that a normal, well-run company would ever care about, because if you look at companies like,
because you don't have anything to do with the $1 billion,
they don't have a use of proceeds.
Right.
Apple, Amazon, Facebook, Google, every bank, they buy their stock back. They generate cash flow by selling products and services, and they buy the common equity back. That's their business model. And that's because their capital asset is a money market instrument. Money market and Treasury bills, 1 month Treasury. 1 month Treasury is yielded on average over 5 years, 2%. The cost of capital is set by the S&P index, is about 14%. So if I sell my equity and I buy the money market instrument, then I'm getting a minus 12% yield, so I'm burning 12% of my capital. That means that if I've got $1 billion in cash and I invest in Treasury bills, I get 2%, but I might as well just give it back to the shareholders because they expect to get 14%, right? So conventional corporate finance wisdom.
Buy the stock.
Is you either dividend out your cash flows to your shareholders or you buy your stock back. And the most tax efficient thing to do is buy the stock back, right? So I have billions of dollars. I buy my own stock back. I surrender the capital to the shareholders. I create more leverage on the equity. The earnings per share is going up because the per share count is going down, right? The share count's going down. That is conventional wisdom. 99% of all companies, maybe 99.9% of all companies just do that. The only company that you know of that doesn't do that is Berkshire Hathaway, right? Warren Buffett says, we're not going to dividend out the cash. We're not going to buy the stock back. We're going to invest the capital because I think I can do a better job. And so that's why they have the largest treasury of any public company, because that was his practice for 30 years. But no one else wanted to do that. Everybody else will brag about the fact that they buy the stock back or they dividended.
But why do you think nobody else follows Warren on that? No dividends.
Okay.
All the REITs, the REIT industry that I compete with,
yeah,
90% of their revenue has to be distributed. I'm like, well, if you got a lot of money and you're a good business, why don't you buy more of your businesses, expand the company? But they can't. So why does?
Well, they think they're buying more of the business when they're buying their stock back. That's what they're doing. The cost of capital, the hurdle rate, is 14%. It's the S&P index. So for the last 100 years, the cost of capital has been generally set by the S&P 500 index. So an equity investor would say, if you're beating the S&P index, you're beating my hurdle rate, you're a winner. And if you're underperforming the S&P index, I could have just bought the S&P index and gone to sleep for a year. And so you're a loser. That's the hurdle rate. Okay, well, it turns out that for the most part, real estate doesn't beat the S&P index. It performs less than, I mean, the S&P is 10% a year for 100 years, right? So, and real estate's maybe 7% or something. The way you beat it is you have to lever the real estate, right? If you lever the real estate intelligently with the right capital, then maybe you can get something that's compelling. Unlevered, it's pretty...
Thank you for being generous there. You were sensitive to my situation.
I mean, there aren't many successful real estate investors that don't use debt.
No, that's right.
Right? I mean, it's all a question of
very difficult.
Like, what kind of leverage do you use and how intelligently do you use it? So if you're a public company, then you're trying to beat that hurdle rate. And so the issue is, okay, I've got $100 billion because I'm making on Microsoft or Apple. Why don't you just buy the S&P index? And there's a simple answer to that, because following the SEC Act of 1933, you had a lot of companies, the Morgan Interest, and they were trust companies, and they owned a bunch of they owned each other's shares. So I would create a company that would then own the shares in 10 other companies. And then this company would own my shares. And then this company would own the shares of my subsidiary. And you had all these interlocking trusts and interlocking companies. And the government decided they didn't like that. And so the Investment Trust, or the Investment Company Act of 1940, the SEC Act of 1940, made it illegal for a publicly traded company to have more than 40% of its liquid assets invested in securities. And it defines securities as the equity of any other company or the bonds maybe of company, but not government bonds. So it gave, technically Treasury bills issued by the United States government are securities, like technically. But for the purposes of the Investment Company Act of 1940, they were given a waiver. So the government passed a law allowing banks, allowing public companies to own government debt, but not anybody else's securities.
Interesting.
And so if you're Apple or Microsoft, you can't just buy it.
You're forced to buy treasuries.
There's only one stock you can buy, your own.
That's right.
So you're Apple, you can buy Apple stock. And so if Apple stock is outperforming the S&P, you should buy your own stock.
Right.
And if the Apple stock is underperforming the S&P,
you're forced to.
You should give the capital back, somehow to the...
rather than buying...
But ironically, the truth is, if you're underperforming the S&P, you still buy your stock, you're giving the capital back, you see? You're just giving the capital back. And then the investor getting the capital back buys the S&P index or something better. So we're getting off topic because you asked me all. They're very interesting questions, and they're important because they explain to you
how you got there.
Thousands of companies do what they do, and why the market is the way it is.
Why the market's broken.
Why the market is, at the end of the day, why the capital market's broken, and why are we leading a revolution in corporate finance thinking? Why is it revolutionary? Because of conventional thinking. So all these companies are capitalized on treasuries, on money market instruments, and the money markets don't beat the cost of capital. So corporate finance theory tells you to decapitalize, surrender all your capital, get rid of it, run on negative working capital, go into debt, do an LBO. I don't want to have $10 billion if I'm Toys R Us. I want to have minus $10 billion. Right? Why did all these companies fail? Because instead of having $10 billion of equity, which would be a liability, equity destroys 10% of shareholder value a year. I want $10 billion in debt. Debt becomes an asset because now I get to write it off, and the debt's depreciating. So we basically encouraged all these public companies to go into massive debt and to decapitalize. And so what's the game changer here? Well, what if I created a digital monopoly, but the asset that you held wasn't a security, it was a commodity? Bitcoin, remember I said, it's like a digital monopoly. It's like the Google of money or the Facebook of money, but there's two ways that it's better. One way, it doesn't have a management team or a company. There's no counterparty risk. There's no one to fail you or rug pull you. There's nobody to subpoena, right? That's a big advantage. There's no workforce to unionize, right? There's no headquarters, right? There's no supply chain. Sorry?
It's not a product that you had to build, create, manufacture.
It's not a company.
Yeah.
Companies have risk factors. Right? NVIDIA is banned in China. Apple is being investigated by the EU. Microsoft can be sued for antitrust. Even the best company in the world, you can attack it, right? If it's not a company, there's no attack surface.
Right.
So that's one way that it's superior. And then the second way is that it's not a security, it's a commodity. And because it's a commodity, it doesn't fall under the Investment Company Act of 1940. So there is no prohibition on having 100% of your liquid assets be invested in a commodity. You can create a company that's got $100 billion of gold or $100 billion of soybeans or $100 billion of
oil.
Natural gas or oil. But most of them don't outperform the S&P over the long term. The only one that even might pretend to maybe is gold, but no one ever bothered, just not compelling enough. And timber and oil and soybeans don't work. They're not good investment assets. So what's the king of all commodities? It used to be gold, By the way, gold is 14% a year for the last 5 years. It's literally tracking the S&P index right now. In an inflationary environment, gold performs like the S&P. That's the king of the metallic or physical commodities in the real world. Bitcoin is the greatest digital commodity. And so Bitcoin gives you a 50% ARR for the past 5 years. So it's triple gold, triple the S&P. So if I can beat the cost of capital, and if I can do it with a commodity, I can capitalize a publicly traded company 100% on that new asset. I can even lever it. I can go to 150%. Okay? And so the revolutionary paradigm shift here, right? The big innovation was take a 100-year-old structure, public companies in the United States, introduce a digital commodity that you can, and recapitalize the company on a digital commodity. If that company is now a WIXI and you start to sell billions of dollars of convertible bonds, those bonds will become the most valuable bonds in the world. And our bonds did. They became the most valuable, the highest performing corporate bonds, the highest performing convertible bonds in the world, because they've got a 50% ARR, 50 vol asset underlying the convertible bond. Then,
so the convertible, let me
Yeah.
understand this. You got $750 million of that, or you did a billion.
No, we sold 10 billion of it.
10 billion. Okay, so
We sold 650 million, then we sold $1 billion, then we sold another 800.
Okay,
then we
so
sold
10 billion.
We became the biggest issuer of convertible bonds in the world over the next 4
the
years.
convertible bond means I can convert what?
A convertible
For what?
bond means
You're converting, or I the buyer, the issuer can convert. Forgive my ignorance
okay.
and my audience.
Okay.
I'm taking it on the chin here.
Okay, I explain convertible bonds.
Yeah, please.
Okay, so I'm a corporation, and I want to borrow money. So I issue a $500 million bond.
Okay.
And I agree to pay you 8%. That's a normal junk bond.
Okay.
If it's unsecured. If I give you security, a lien on all my assets, it's a secured bond. Maybe I pay you 6% then.
You'd pay a lower because it's secured.
But what if I don't want to pay 6% or 8%? What if I actually want to pay 1 or 2%? Okay. There's another group of buyers of bonds. They're convertible arbitrageurs or convertible bond investors. I can sell a $500 million bond to a convertible bond investor where I pay them 1%. And you're like, well, why would they take 1%? It's because I agree to pay you back the $500 million in 5 years, either in cash or in equity at the time. And meanwhile, I will give you an option, a warrant to convert that into $500 million of equity at a 40% or 30% premium to the current price of the stock.
Oh, got it.
For the next 5 years.
Anytime in that 5 years.
So I'm giving you a stock option to buy $500 million of my stock for 5 years. And that option, if the stock is trading at $100, the option would be worth 20 or $30.
Got it.
Right? So I'm giving you a $30 option, and I'm also giving you a promise to give you back the $100 principal. And
so the investor knows they're going to get 30% of their money.
Yeah.
Yeah.
Yeah. And then what they do is they turn around and they're shorting your stock into the market in order to they eliminate all the risk. They basically hedge out their risk, they're arbing out the risk, and then they're just getting the upside. And so it's a different type of investor, but a convertible bond is a bond with an option tied to it.
And who's the buyer of that, or who's the seller? I guess the issuer.
The seller is my company, a public company.
So who's
the issuer? Who's
going to be the investor on the other side? Give me the name of somebody that would be like
Millennium, Soros, Citadel.
These are just
big hedge funds.
Big,
mega hedge funds with billions of dollars.
And this is their mandate is to find opportunities like this.
Yeah, there's $100 billion.
I've never raised money from those guys.
It's a part of the bond business, and they buy convertible bonds.
This is their job every day to go place
every day.
this money.
Every week there's a deal like that. That's what they do.
And you knew this. Did you know this in the beginning, or is this?
No, I discovered it.
Yeah.
Somebody pitched that to me.
I got it.
So, because the kind of issuer that can sell a convertible bond is a company with a very liquid stock that's very volatile. because if you value options, you basically use the Black-Scholes equation, and the input to the Black-Scholes equation, which is first order most important, is the volatility. So if you have a stock with a volatility of 20, the option's not that valuable. But when the volatility goes to 80, the option becomes extremely valuable. Since I'm selling you a convertible bond and it comes with an option, right? A convertible bond issued by a company with a vol of 80 is going to be extremely valuable to the buyer. And that's why, that's how we can sell $1 billion bond at 0 coupon, right? I only need to know 2 things. I need to know that there's enough liquidity that I can hedge it in the market. So if you're trading $1 billion a day, I can hedge out the bond so there's no risk for me. And then I need to know there's volatility. And then I need to believe the volatility.
Volatility refers to what? You're talking about it going up and down violently?
Okay, volatility is another word for standard deviation. Okay, so if I have a stock and it trades 100, 100, 100, 100, 100, 100, it is 0 vol.
Yeah.
There's no volatility.
Right.
And if it's trading like this, plus or minus, 10, you've got like a 10 vol.
Got it.
And then when it's trading plus or minus 80, call it an 80 vol.
Yeah.
Right?
And I want the vol. You want the vol.
Okay, well, the guy that wants the vol is the options trader because he's going to buy it here. He's going to short it at 80. He's going to buy it back at 20.
Yeah.
He's going to short it at 180. Right?
Do you play any of this game? Do you play any of this shorting?
I'm on the other side. I'm creating the tool for them to short.
Yeah. This is where the offerings came.
I mean, Grant, think about a roller coaster, right? I mean,
yeah, I hate to think about them, dude.
Okay.
I can't invest like this.
But the point is, when you go to an amusement park, you want to go on the roller coaster ride.
Yeah.
If the roller coaster doesn't do this up and down and go fast and
but I
give
don't
you
like
G's,
doing that when I invest. That's why
it's not fun, though.
Yeah.
It's not fun. So the
I got enough drama in my life, though.
Yeah, well, but the point is, there's 2 types of investors. There's the investors that actually trade the volatility. They need the volatility. And then there's investors that just want to get wealthier with no risk, no volatility. That's a different type of investor. If you want to actually serve the latter, you have to understand the former because you're in this system together.
You're providing a product over here for these guys.
So my point is, we created a company. We plugged a highly volatile asset, Bitcoin, that was 50 vol. It was growing out 50% a year with 50 vol. So call that a 50-ton flywheel spinning 50 RPM. Okay, right? Can you imagine a 50-ton weight spinning 0 RPM? That's just a sculpture.
Right.
In your backyard,
good enough.
that's just a heavy sculpture.
Got it.
But if I shape it like a flywheel and I spin it 50 times a minute, that's a dynamo, right? That's a generator. I can generate power off of that. If I put that on the back of a train and the train goes 50 miles an hour, there's a lot of energy in that system, right? So what I did is I put an asset going 50 miles an hour, spinning 50 times a minute, and then the issue is how much weight is it? Well, the number of dollars of capital. If you have $1 billion of capital spinning at 50 vol, appreciating at 50% a year, that's a lot of energy. But if you have $10 billion of capital, that's 10 times more energy.
Right.
You get $100 billion of capital, that's 100 times as much energy. So we put that Dynamo, we put that asset, Bitcoin, in the middle of the balance sheet of the company. And at that point, that creates liquidity and volatility, and we became the most volatile stock in the S&P index. We're not in the S&P, but we became more volatile than every stock in the S&P.
You were up this last quarter to be in.
Yeah.
They passed you up, huh?
Yeah.
Little chip on your shoulder.
Different story.
Yeah.
No, I'm
We'll
good.
do that later.
It all works.
So how do I do this? How do I do this Dynamo? How do I create this? How do I take this real estate that's very heavy?
This is why I told you, put a huge amount of Bitcoin in the company.
Okay, we're doing that.
Right? If you take a company with $1 billion of real estate and you can bolt on 500 million of Bitcoin, it's all of a sudden got a Dynamo. If you bolt on $1 billion of Bitcoin, right? Now you've got a digital real estate company. You take that public, and that's going to have a lot more liquidity, a lot more volatility. Now you can sell a convertible bond, and you can use the convertible bond proceeds to finance whatever you want inside the company. So you get cheap cost of capital, right? Let me just finish my story,
please,
right?
Please.
Right. So after the company discovered the convertible bond market and we started to feed it, we discovered the ATM market for equity.
Right.
And so we created an ATM, and most companies would never have a reason to sell equity. They're buying their equity. We became the first big, well-run company with a reason to sell the equity. If the equity is valued at more than the underlying asset, so if we're trading at 2 times NAV, right? If we have $1 billion of Bitcoin and the company's worth $2 billion in equity value, we sell the equity, $1 of equity. We buy back the Bitcoin, and we capture 50 cents of profit on the round trip transaction. So you could sell $10 million.
The stock's $1.
The stock's $1, and the company owns 50 cents a share worth of Bitcoin.
Got it. Mm-hmm.
So I sell the stock for $1, and I buy back $1 of Bitcoin.
Is that how you come up with your BTC yield? That's what you talk about, the yield.
Yeah.
For a long time, I'm like, what yield is he talking about?
If you have $1 billion of Bitcoin, and then you sell stock, $1 billion of stock backed by 50 cents a share of Bitcoin. If you sell the stock at MNAV of 2, then you're going to sell $1 billion of stock backed by 500 million of Bitcoin, buy back $1 billion of Bitcoin, capture a $500 million gain. You captured a $500 million gain on $1 billion of Bitcoin. You've just generated a BTC yield of 50%. You see, you got a 50% tax-free dividend by simply selling the appreciated stock, buying back the underlying asset. So the BTC yield's a function of how much of that can you do versus your balance sheet. Okay, but back to my story.
Yeah, I'm sorry to throw you off.
You got a million questions.
No, because you're sitting on 640,000 Bitcoin doing this.
Yeah.
Is that right? Somewhere around that, and more
now.
More on Monday.
More now.
A lot more.
A lot more now.
So curious.
We figured out that we could do an ATM, and so we could sell the stock. We could sell $1 of stock backed by 30 cents of Bitcoin, buy back $1 of Bitcoin, capture a 70% spread. And so we got to the point where we're doing it 10 million a day, then 20 million a day, then sometimes 500 million a day. We got pretty good at it, and we did a few billion of it. We made $1 billion doing that. And then in October 30th of 2024, we had to renew that ATM shelf registration. It was a week before the elections, and we decided, well, what the heck? 21's a magic number for Bitcoin, so we're going to file a $21 billion shelf registration to sell $21 billion of equity. No one had ever done that in the history of the world. That was the biggest equity filing in the history of the capital markets. But no one ever had a use of proceeds. And at this point, our shareholders trusted us, and they knew that every single time we did a transaction, it made them money. Right? If you want Bitcoin and I buy the Bitcoin and I sell the stock at a premium to underlying Bitcoin, you just made money risk-free, you see. And so the BTC yield shows you that that was an accretive transaction. You got more Bitcoin per share. And so we came up with a way to do a high-speed accretive transaction. We could literally do it the same day, right? So it's like, I do $1 billion, I raise $1 billion, I develop $1 billion of real estate, I fully lease it out, I can show you I made money on it, I put that news on the wire, I go back next week, I raise another $1 billion. Mm-hmm. Imagine if you could just do that with no risk every single week, right? You're running 1,000 times faster than the real estate business. That's what we did, and we learned that. We stumbled onto that. We kind of figured it out. We developed all the metrics like BTC yield. If we were to do a deal where the BTC yield...
Is this you doing this, your team? Who gets to take the most credit?
We did it.
I know there's a we, but...
We did it.
You know.
I invented the metrics.
Okay, thank you.
Yeah,
thank you. I think the individual is
necessity is the mother of invention.
Yeah.
And so, you know, I drew
You're dreaming this up at night. I just want to know Michael Saylor sitting around his house over...
My first job was creating computer simulations. I basically did this for a living. I created metrics and models.
This is your simulation coming to reality.
I was able to use some of my, engineering training from MIT.
Yeah.
So anyway, we create the math and we create the system and we do it for a few $1 billion. And then along comes October 30th and we filed the $21 billion shelf registration. And the message was, we're only going to sell the equity if it's accretive to the shareholders. Well, if you were a conventional company and you did that, the stock would crash because people would think that's dilutive.
Dilutive, yeah.
But if people believe that I'm going to use the capital to make the money, it's accretive. Mm-hmm. And that just comes down to trust in the management team, right? And alignment. Do your shareholders expect, it's just like whenever you raise money, if they thought that you were going to lose the money that they gave you, they wouldn't give you the money.
That's right.
And if they thought you were going to make money for them that was more than their hurdle rate, risk adjusted, they would give you the money.
Yeah.
It's just a basic matter of, do I trust the management team to be a good custodian of my capital? So we got to the point where we've been doing it for a year. So we announced a $21 billion shelf registration. The stock trades up.
Were you surprised?
The next day. No, I wasn't.
A little surprised?
Other people were, but I wasn't.
Were you happy, elated?
Look, I'm the guy that built the bridge, and I'm like, it's a steel bridge. We're going to drive a truck over the bridge. It'll be fine. Everybody else thinks we've never done that before. The bridge is going to collapse.
Right.
Howard Hughes flew his own airplanes.
Yeah.
So I'm just the guy that thinks I built the machine. I think the machine is going to work. And so, if I waited for skeptical people to believe the machine was going to work, there would be no machines in the world, right? Yeah. Nothing would be done. Ever. Right?
Right.
The great irony is that, in 1902, every learned aeronautical engineering professor was sure we'd never fly. Mm-hmm. And the guys that went flying were the Wright brothers. They were bicycle mechanics without a degree. It's like sometimes you need the guy that's just going to do it that doesn't know why it can't be done because other people, just engage in some mental gymnastics to convince themselves that their lack of courage is totally justifiable and it's okay for them to not do anything. Okay, so back to October 30th.
Yeah.
We filed the registration.
I really appreciate your time because I know you got a lot going on. So thank you.
We filed the registration. The stock trades up. We start selling the equity. When we're doing that, we're selling $3 of stock backed by $1 of Bitcoin. We're buying back $3 of Bitcoin. We're basically selling dollar bills for $3.
Jesus.
And we're doing it, $10, $20, $30 million a day.
And you're using somebody like Clear Street or...
we just sell in the open market.
You're running this? Or
we have bankers. We have bankers in the syndicate. So
the banker's calling you saying, hey, you want to do another 400 million or 500?
We give them instructions. It's just like if you had a block of stock and you wanted to sell $20 million of stock in a day, you'd call your broker and you'd say, you can sell the stock. The limit is $89.42 or better.
Yeah, that's at the market. You're like, this is...
Something like that.
Yeah,
right?
okay.
You give, you can give them a limit order. You can say sell it over, sell it at the market for the next 8 hours.
Right, got it.
You give whatever order you want. So we have, fairly sophisticated trading routines, but you can imagine they're not that complicated. It's like if the stock is crashing, don't sell it. If the stock is raging north, sell it. And then Trump gets elected, and there's a red sweep.
Yeah.
And Bitcoin is 55,000 in the beginning of September.
You're friendly with those guys, right?
Yeah. I have relationships. Don't interrupt me, man. I'm trying to tell the story. I'm trying to tell people how to make money.
Okay. Come on, let's make some money, guys.
Bitcoin is 55,000.
Can I interrupt you one more time, though, just so the audience knows? First time I meet this guy, he says to me, this is what got all the trust from you to me.
Okay.
You said... If you really want to get wealthy, really wealthy, and that's the first time anybody laid that out, like, let's just get that out of the way. Like, there's nothing wrong with making a bunch of money. You agree with that?
No, nothing wrong with that at all.
And he said to me, if you really want to get wealthy, figure out how to add Bitcoin to your real estate.
I did say that.
Back to your story.
I did say that.
You'd meet the Trump just won.
So... Bitcoin's 55,000 in September. It's maybe 68,000 the beginning of November. And then all of a sudden he wins, and it runs from 68,000 to 106,000 in like 5 weeks. Okay, this is the raging, crypto wave. And we started selling 500 million of equity a day. And we're making 300 million a day on the trade.
300 million.
And then we have $1 billion day. And I think one day we had a $2 billion day.
This is more cash than you had 5 years ago.
So we blow through we thought it would take us 3 years. We might actually get through the equity. We go through the entire $21 billion program in weeks.
Oh my God.
And so it's the largest issuance of equity in the history of the world. And when we sell the 21 billion of equity, we make like $13 billion in gains on the Bitcoin just in the round trip. So we generated $13 billion just by exploiting that ATM. And that's because all the equity capital markets investors, they wanted exposure to Bitcoin. Between the people buying the equity and the people buying the derivatives and all the levers that came in, there's just a wall of money comes. And so I don't know, we raised more than $20 billion
this year
in 2024.
Okay.
In 2024, we raised more than $20 billion. And then we roll into 2025. And now we get to the point in the story where you're like, well, when did you realize you're leading an industry or a movement? Well, it's kind of like in 2025, because in 2025, we renewed the $21 billion program. We had maxed out the convertible bond industry. We basically we became the biggest issuer of converts. And we started thinking, not how are we going to sell the next 5 or 10 billion? How are we going to raise the next 10 billion? The issue is, how do you raise the next 100 billion? How do you raise the next 200 billion? How do you become $1 trillion company?
Damn.
And at that point, I took everything I'd learned, right? And you kind of have to build it the first time to build it the second time and break it so you can build it the right way the third time. The iPhone 3 was the winner. Yeah. It just takes, the jet engine you're in right now is not the first version, right?
Definitely.
So we get to 2025 and we started thinking, what do we really want to be when we grow up? And we realized, convertible bonds are a nice trick, and selling equity at a premium is a nice thing to do. But ultimately, you're not going to be a multi-trillion-dollar company by doing that. What is the thing that the world needs? And what do we need? Well, what we need to do is we need to be able to sell $100 billion of credit instruments that create amplification for the equity. And we need to do it without credit risk. So how do you actually raise $100 billion and take no credit risk? So we don't want junk bonds. We tried bank credit with Silvergate. The bank failed. We tried senior notes, and that was it was like a yoke around our neck. We had too many covenants and EBITDA covenants and the like, so that didn't work. And then we tried convertible bonds, and we did 10 billion, and they were successful. But at the end of the day, they weren't going to scale
because
they trade over the counter. It's illegal for a retail investor to buy one.
Jeez.
Back to all these securities laws, they're 144A issues. So that means you have to have $100 million of capital, being a qualified institutional buyer, and they trade over the counter. And over the counter is it's a polite way, it's a euphemism for, 32 dudes trade with each other with one broker in the middle. It's like a
Diddy party to me.
It's like a bunch of guys meet in the back alley in the corner, and they all trade with each other in the back alley, and there's a bid-ask spread, and there's no trades for the last 18 days, and you can't get the bid quote or the bid-ask quote. You have to pay $25,000 a year for a Bloomberg just to know what the last trade was. It's too difficult. And so what we discovered is they were illiquid instruments, but maybe more importantly, what we realized is they were literally investment grade, like they're 50x over collateralized. So imagine a bond where you've got $50 of capital for every dollar in the bond, and it trades like triple distressed debt going out of business. The credit spreads were like it was a triple junk bond going out of business, but the backing collateral was triple investment grade. And so if someone said to you, I want to be 50x over collateralized and I want you to pay me 20% interest, you're like, that doesn't seem quite right.
Right.
And so we just realized it wasn't good for the issuer. It wasn't even good for the buyers. It only makes sense for the convertible arbitrageurs, but the convertible arbitrageurs, they're not long Bitcoin. They don't want to invest in Bitcoin. They don't want to invest in the company. They're not really even credit investors. They're traders. And so we started thinking that we needed to fix the credit. And so we basically traversed from bank credit, asset-backed loans, senior credit, convertible bonds. And we started thinking, why don't we sell preferred stock? And preferred stock is like a bond, but it's perpetual. So I sell you $100 million of
Perpetual
preferreds. Means it never comes due. Mm-hmm. I'm going to borrow $100 million. I'm going to pay you 10% dividend a year forever. I'm never going to pay you back the principal. It's equity. And I approve the dividends. If the company can pay the dividend without being insolvent, then the company pays the dividend. But the board is not allowed to pay the dividend if it would render the company insolvent. So you see, if you sell a preferred equity instrument, by definition, there's no credit risk. You can never be in default. You see? If you structure it right, you're not paying back.
Because it's first in line?
You're not paying back the principal ever.
Okay.
How do you default on that?
Right.
You're not paying it back. Mm-hmm. And the dividend is not a coupon. You can't be in default. You can be in default if you don't pay the coupon on a bond, but on an equity, if you skip the dividend, you might have an obligation to accumulate the dividend and eventually pay it, but see, you're not in default. You see. Not in the same way that you'd be in default on senior debt.
Right.
In senior debt, you pledge collateral, you miss the dividend.
Has this been done before?
People have, preferred stock have been around forever.
Okay.
Yeah, I mean, I didn't invent preferred stock. It's just I invented the idea of putting preferred stock together with digital capital.
Mm-hmm. This is STRK?
The first deal was STRK, mm-hmm. Strike. Then we did Strife, then we did Stride, then we did Stretch, STRC.
Four this year.
5 this year.
5, excuse me.
Last week we did Stream, STRE.
Level.
Yeah, we started moving fast.
Dude, crazy.
And so 2025, you said, when did we start to take a leadership role? I would say we went from desperation and frustration to being opportunistic, and tactical. And then it was really in 2025 that we really became transformed into a new business. Because
what was the funnest stage of those three?
Oh, now is the funnest stage.
Oh, it is?
Yeah, because now we invented a new business.
Right.
And let me describe the business.
Please.
It's digital credit. Basically, we created a new asset class, digital credit, backed by Bitcoin, which is digital capital. And we created a new business model, digital treasury. So we're a treasury company. We sell securities, we buy capital, and then we create credit instruments. We sell the credit. And the credit, digital credit is 100x better than conventional credit. Because first of all, it's built on top of appreciating collateral. Bitcoin's going up 30% a year. It's not on depreciating collateral. When you create credit on a warehouse or you create credit on an iPhone 17, these products and services and buildings are, the Rockefeller Center has got a 40-year, 50-year life before you got to do a full rehab, right? Renovation. So you've got appreciating collateral, not depreciating collateral.
Because
then
it's Bitcoin.
Because it's digital capital, because it's Bitcoin. Because Bitcoin is good for, remember when I told you it's like useful life is immortal?
Right.
What, would you like to build, what if I gave you a building that was maintenance-free, tax-free forever and never rusted?
Please, quit talking like that.
It would change the economics of real estate, right?
Everything.
Okay, so that's kind of what we did. We built it on a digital building. Okay, so that was the fundamental, but we did a bunch of other things.
It's debt without the CapEx.
The second thing we did is we created the credit as an equity instrument, not a debt instrument. That means it's an asset on the balance sheet. It's not a liability. Okay. The third thing is we made it perpetual equity. There's no call provision. There's no refinance provision, which means that the people that bought the instrument can't call it back or redeem it. For example, when you're a bank, if I put $1 billion in your bank, you've got the capital, but next Tuesday I can actually withdraw my money. And so you've got the money for 2 days. Bank deposits are temporary capital. If I gave you $1 billion and you gave me a 5-year note, a corporate bond, you've got the money for 5 years, but in 5 years I get it back.
Right.
If I gave you the $1 billion in a preferred that was perpetual, you've got the money forever. I'm not getting it back. So we created a perpetual credit instrument, not just a temporary credit instrument. That's the third innovation.
Okay.
The fourth innovation is that all of the credit was based upon that digital capital, so it's all transparent, homogeneous, real time. You can recalculate the credit risk every 15 seconds. Like, you know, we're 10x over collateralized on Bitcoin. You plug in the price of Bitcoin, the volatility of Bitcoin, your forecast of Bitcoin, it spits out statistically what is the risk of being under collateralized over the term of the instrument. So that's the third thing. And then we took it public. So we made it public credit, not private credit, which means that there's a ticker, STRK, STRC. It's got a name. You can buy this on Robinhood. Mm-hmm. It's got a happy name, and you can find it in Australia,
what does
right?
a happy name mean?
What I mean is it's a 4-letter ticker, and it's a name called Stretch.
Right. Uh-huh.
Okay, can you name the 19th tranche of JP Morgan corporate debt?
I cannot.
Can you find it?
No.
It's a CUSIP number. The point is that's private credit. And actually, that's over-the-counter credit. Private credit is, okay, somewhere someone has a loan, you know, from somebody else. So you see, we went public, and
that's a new thing. Nobody's done that.
No one ever did that, right? And we listed it, and when we listed it, we attached a shelf registration to it, that ATM. So we were taking these ideas, Bitcoin and the ATM and the preferred and the public, right? And then we're putting the shelf. And why is the shelf registration important? Because that meant that when we sold the billions of dollars of it, if there's demand in the market at 3:55 p.m. on a Thursday for $50 million of this instrument, someone buys it, we sell it, the price doesn't move a penny, we create the $50 million of credit in the next few minutes in real time. So complete digital liquidity, digital creation. Like, if I gave you $1 billion and I said, now I want you to go develop $1 billion worth of real estate, or I want you to like scrape together $1 billion worth of home loans,
right, or
issue $1 billion worth of mortgage-backed securities, that takes people and time, and it's heterogeneous. And maybe there isn't $1 billion worth of underlying collateral. So,
or worse, I have to drop down in order to fulfill it. So
you have to
degrade my purchase.
So maybe it becomes heterogeneous, right? The first $37 billion of Chicago mortgage-backed securities you created were this level, but the next $37 billion...
It's going to deteriorate.
Yeah, you know, it's kind of common sense, right? You know, the faster I give you the money, and the harder it is, then the more degraded the credit, maybe the lower the returns.
Yeah.
But you see, with digital credit, it's completely homogeneous, instant, real time, right? What is the quality of the credit? Well, you're backed by $5 of Bitcoin. What about this tranche? This is backed by $5 of Bitcoin. Well, what happens if you slam the market with $27 billion of demand? Okay, now it's backed by $4 of Bitcoin. Your BTC rating went from 5 to 4. Well, how much risk is that?
So BTC is a rating now.
BTC rating is another metric. It is,
crazy, man.
Well, we had to create a credit model. So BTC rating of 5 means
BTC yield.
You have $5 of Bitcoin for every $1 of a liability or a nominal, credit instrument. And common sense says a BTC rating of 10 is better than a BTC rating of 5, right? And so the credit is created instantly. The credit risk is transparent. And that means that the instrument trades with less volatility. So if you look at Stretch, when Stretch gets to $100, we can pretty much peg it at $100 plus or minus 2 pennies. because we've got the ATM on it, and that at the market registration means if someone came in and wanted to slam the price to 102, we're just holding it at $100.01.
Well, how can you hold it?
Because we're selling the instrument.
You're selling it, so the more you sell.
Yeah, if you wanted to buy $1 billion, if you wanted to buy $1 billion,
if you wanted to go to 102, you would do what?
I would just sell $1 billion at $100.01.
But okay, so yeah, but how are you controlling it not getting to 102?
We're selling it at $100 and a penny.
You're controlling the price.
We're selling it at a penny.
Got it.
So how's it going to go to 10 cents if I'm selling it at a penny?
Right.
You see, the innovation
how are you controlling what it sells for if the market's there?
Well, we're in the market, but if we're willing to sell $80 million worth of the instrument at 2 cents, it's not. Why would you want to pay 10 cents if someone will basically meet your order at 2 cents?
Right.
This is just the way the market works.
Okay.
The point. Let me say it a different way.
Yeah.
If you have a stock and you cannot sell it and everybody wants to buy it, the price goes up.
That's right.
And if you have a security and you're willing to sell $2 billion of it and the average trading volume is 100 million a day and you're ready to sell $2 billion of it, the price is not likely to double or triple.
Yeah.
Right? Because you're making the market. Okay, so the point here is we created a preferred stock. We attached a shelf registration to it. We pay a dividend on it. The dividend is backed by Bitcoin. And because we're willing to create more of the instrument, if there's more demand, the price is stable. Becomes stable. If we weren't willing to create more, and if there was twice as much demand and we wouldn't sell any, the price has to go up.
Yeah.
But it turns out you don't want the price to be fluctuating. You don't want the volatility.
This guy wants income.
Yeah, and so let's take Stretch. What is Stretch? It pays a 10.5% dividend at par at $100. Okay, so if you wanted to buy $1 billion of it tomorrow, you don't want to pay $200. You want to pay $100.
Yeah.
So the only way to make sure that you can buy it for $100 is someone has to be willing to sell you $1 billion, and that someone is our company.
Are you going to stay current on that 10% or 10.5%?
The way that works is every month we adjust that dividend rate, and if the security is below 100, if it's weak, if it's below 99, we raise the dividend rate. Mm-hmm. And if we ever thought it was too strong, we could lower the dividend rate. But right now, you should think of it as a monthly dividend, 10.5%. And that takes me to the last point I want to make. The digital credit instruments are superior because we pay rates which are double or triple a money market. Like we're paying 10.5%, your money market's paying 4%.
Yeah.
And in Europe, the money markets pay 2 or 1.5%. And the second reason they're superior is because they're return of capital dividends, what we call ROC dividends. Mm-hmm. If the issuer is funding the dividend by raising capital in the market, if we sell equity in order, or we have a business that keeps negative earnings and profit, then any dividend we pay becomes tax deferred to the recipient.
Right. It's like refinancing a piece of real estate.
You see it happen occasionally in the real estate business, occasionally in oil and gas or master limited partnerships. It's not a new idea. Mm-hmm. None of these things I've done, Grant, are new ideas. It's just I put together 100, return of capital tax law from 1910 with the SEC 40 Act, with the ATM from 30 years ago, with preferred stocks, with Bitcoin. You combine it all together, but the result is, if you're a New Yorker, you're getting 10.5% tax-free, and that's a tax equivalent yield of 22%.
Yeah, it's huge.
So it's what we did is we created a digital credit instrument that gives you a tax equivalent yield of anywhere from 16 to 22%, depending on whether you live in Miami or New York or San Francisco. And we created a company, right? We discovered the asset, digital credit, because we wanted to escape the credit risk of bonds, you see, and we wanted to scale the business. It was a necessity, was the mother of invention. Mm-hmm. So we created it. We created it with digital capital and digital intelligence, with AI. We had a clean sheet of paper. We had like infinite money, and we could do anything, and we're a public issuer. So we create the perfect credit instrument. For what? Well, if the issuer wants to sell $100 billion with no credit risk, it's perfect for us. But it's also perfect if the recipient wants to collect billions of dollars of fixed income tax efficiently. It's perfect for them. Who isn't it perfect for? Everybody in the middle, the traditional finance establishment, 20th century banks, 20th century investors, 20th century credit markets, right? We just bypass them and we create something.
Why is it not perfect for them?
Because they sell 144A over-the-counter issues and they trade with each other. It's like there's an army of 10,000 private advisors with Bloombergs that trade with each other that are going to put a 6% yielding bank preferred in your portfolio until you die. So the existing 20th century credit establishment, they're selling you stuff that pays you 5% taxable. Okay, well, so there's $300 trillion of that garbage.
Yeah.
Okay, and we're creating something which is 10% tax deferred.
Yeah.
Okay, so it's better, four times better than what the conventional world has. But the winner is the investor, the public investor, the consumer, small business, and the winner is the issuer. And the winner is Bitcoin and the crypto economy, right? Because we're funding the crypto economy. Our shareholders are winning. We're winning. The investors are winning. But we're just disrupting the traditional credit markets. And now my last point, we invent a new asset class, digital credit, and then we discover that as long as the company has cash flow or earnings less than the dividends, we're in a negative earnings and profit situation, which means that we're issuing ROC dividends or return of capital dividends, which means they're not taxable to the recipient until they sell the underlying instrument. And so that's a discovery, right? That's just another serendipity. You know, if you look at my entire journey, it's like
you're showing up and then you see something.
We did, we tripped over being a WIXI, and we discovered we had a great derivatives market, and we discovered we could sell converts, and then we discovered we could create digital credit, and we discovered we could pay ROC dividends. And so all of a sudden the heavens open, and we see the big picture. Here's the big picture. We're the world's most tax efficient generator of fixed income, and also we're the most scalable one. So what company could basically generate $100 billion of dividends that are tax deferred and grow the business 20% a year? Nobody other than a digital treasury company capitalized on digital capital selling digital credit with a laser-like focus. And I would love to tell you, in March of 2020, I figured it all out. I didn't. In March of 2020, I was just irritated, frustrated, and angry and desperate. And it's like, I'm either going to fight or die. And so we went on a journey to fight and not die. And we popped out. We popped out having discovered a new business model and a new asset class and a new mission in the middle of 2025. And what I would say today, you say, well, what's the mission of the company? Well, our job is to provide 1 billion people with a bank account that pays them 10% tax deferred. And it's a big idea in the US, but in Europe, they're getting 150 basis points. In Switzerland, they're getting nothing.
Right.
In Japan, you're getting nothing. So how about give me 10% tax deferred, strip the volatility away, strip the risk away. Just give me a extremely low volatility, low risk way to get paid 10% while I figure out what I'm going to do with my money. And if you boil this down to the entire investor thesis today, I would say, if you have money you don't need for 4 years or longer, and you don't trust anybody, you buy Bitcoin. And I think maybe you get 30% a year for the next 20 years. If you have money you don't need for 4 years or longer, and you're in love with a business model, whether it's digital real estate, whether it's digital credit like my company, whether it's digital intelligence like NVIDIA, then maybe you buy the equity. If you think you can do better than 30% a year, right? And you've got a long time horizon. If you have money you need in the next 4 years or the next 4 weeks, you buy credit. You buy digital credit, ideally, because the digital credit's going to pay you 2 to 4 times more than conventional credit. And the digital credit we're describing probably performs like the S&P index or better, but without the volatility, with more stability, and that provides a solution for everybody and everybody's pool of capital, and everybody's got some money they need in 4 weeks, some money they need in 2 years, and then some money they want to invest forever and give to
different
their
investors.
And you think that through. And that's become very clear to us now. But I would say I probably couldn't have told you that a year ago. Yeah. All I knew a year ago is we have a good thing. We're going to figure it out.
Mm-hmm. Let me ask you, so things are going good. Things are going great. Everybody's happy. Okay. Now we're down this morning. We're down, touched 95 or 94 or something.
Yeah.
MSTR is down on the year. How do you handle, and I'm asking for myself, how do you handle that when you have basically a ticker symbol on your T-shirt every day and people are judging you by the price of something? Like, what do people come up to you? Hey, get it up, Mike. Get it up.
Well,
get the price up, man.
First of all,
and then I saw the Titanic. I'm sorry to interrupt you, but I saw the Titanic this morning, and you in front of it, the meme. You got the best memes on X. And then I think some other people are suggesting that the ship's going down somehow. Like
the ship we're referring to is the traditional establishment, and you want to step off.
Oh, got it.
Right. That meme in the Bitcoin community means Bitcoin's the lifeboat, fiat is the Titanic, and you should step off the traditional 20th century economy, wherever it might be. But how do I deal with it seriously? If you're running a company, you have to be making investments and taking actions that you think are going to improve the company 4 years out. Like everything we do, I expect to get a return within 4 years. Mm-hmm. I might be willing to wait 10 years, but I don't expect it to take 10 years. I expect that I'm doing things now that might pick up in 12 months or 24 months or 36 months. I don't think you can do things that are guaranteed to pay off in 12 months, because if you did, you would do nothing. Mm-hmm. And if you look at the company over the last 12 months, our stock raged. It went through the roof in November, December of 2024. But at that point, we had not raised $40 billion in capital. We had not generated $25 billion of BTC gains. We went from $5 billion in equity or $4 billion in equity to $60 billion in equity. We had not added $50 billion of equity. We had not invented digital credit. We had not done the first IPO, the second IPO, the third IPO, the fourth IPO. The fourth IPO was the biggest IPO in the country, in the United States this year.
The fourth was what?
Stretch.
Okay.
$2.521 billion. And then we hadn't done the fifth IPO, which is more IPOs than any company's ever done in the history of the capital market. So if you look at it,
not a bad year.
And the first 20 years of my life, I had $1 billion idea, which was MicroStrategy business intelligence software. And then I looked for the second $1 billion idea for 20 years, couldn't find it until 2020. And in 2020, I found the second idea, which was Bitcoin. And then the third idea, which was convertible bonds. And then the fourth idea, the ATM. And then this year, it was strike, strife, stride, stretch, stream. And we hit $5 billion ideas. And Stretch is already a multi-billion-dollar idea. And if it works, it'll be $100 billion or $1 trillion idea. And all of that is ignored in the market. So the market sentiment, the market sentiment is negative, and in the near term, it's going to be driven and overwhelmed by macro hysteria, right? Macro sentiment about the interest rate, about risk on, risk off assets. And if you ever listen to short sellers talk about their short thesis, they're strategically ignorant. Like they want to not understand anything you're doing because they just want to say something simple.
Yeah.
Oh, the company trades at a premium to the underlying asset. Ha, ha, ha. Well, so does every other company on earth. So does every bank, right? That's called price to book. Every finance company, every company on earth trades at a premium to assets. Of course it does. That's not the reason to short the stock. the reason to short the stock is you don't like the business, but the business is selling billions of dollars of digital credit. And so you have to have an opinion on that before you can have an intelligent short thesis. That we're not really at that level of the dialogue. So I'm certainly not going to do stupid, panicky things because there are other stupid, panicky people in the market, right?
Yeah.
That's like allowing yourself to be dumbed down to the lowest common
these guys are
denominator.
gambling. I mean, these guys are gambling for a short term.
And you also got to keep in mind, there's a lot of times the stupidest, most obnoxious post on X is the one that runs the hardest. And even the stuff that's not even true. Someone posts something which is not true and not even believable.
Yeah, that you were selling this morning. I think somebody was saying you were selling.
That goes viral.
Yeah, totally.
Right? That goes
news
viral.
always goes viral.
So you can't take that too seriously.
Yeah.
Like you can dismiss it, as it's an unfounded rumor in about 5 seconds. But like, I don't spend a lot of time thinking about that.
Yeah.
I spend my time thinking about how do I launch a Treasury credit instrument in Japan that I can sell $1 trillion of to the Japanese to invert the Japanese banking industry and capital markets. Right? That's what I'm spending my time on.
What's driving you, Mike? What's driving you? Like, what keeps you up to get you thinking about doing this? Can't be money.
At this point, first of all, Bitcoin represents the apex property rights of the human race. It represents, financial integrity and empowerment and economic rationale for the human race. So that clearly is a spiritual driver. And then I think in my professional life, what drives me at strategy is the realization there's $300 trillion of conventional credit and it's paying you like 200 basis points.
Right.
We live in a crippled credit economy. It's a yield starve. In what world does it make sense that $7 trillion in Japan yields nothing? Or that banks in Switzerland steal your money? Like you're getting negative 50 basis points in the Swiss franc. Or if you live in Europe, how is it fair or equitable or rational that every European is expected to accept 150 basis points from a euro money market for their capital when the fair free market value is somewhere 8 to 10%? So what drives me is why don't we just go give everybody 10% yield in euros and 10% yield in yen?
How much money?
And 10% yield in dollars.
Yeah.
And Grant, what's the perfect product? I'm going to tell you what I think the perfect product is. The perfect product is I give you 800 basis more than the risk-free rate in the currency of your obligations forever. Okay? The perfect product is a product where your unborn child benefits from it before they know it exists. You're deaf, you're dumb, you're blind, you're in a coma, your arm is broken, your eyes have gone bad. I used to think the iPhone was the perfect product, but we're on the iPhone 17 Pro Max.
Yeah.
They have to upgrade it every year. It's not the perfect product.
No.
If your eyes go bad, you can't even read the product.
Right.
How about I'm just going to give you money forever, a comfortable retirement, and you just do whatever you want? Pure economic energy. You buy this, and it just pays you for your life, the life of your children, the life of your children's children, the life of your great-great-great-great-grandchildren, and it's always more than the underlying inflation rate. Okay? That's the perfect product. So what drives me? Sell the perfect product to the entire world. You give 1 billion people Social Security, and you don't have to gamble your money on the latest equity idea. Why should you have to give your money to a hedge fund that charges you 2 and 20 when you could just have 10% tax deferred forever, no risk, and sell in and out of it whenever you want? And I think, how can you, if you convert 10% of the credit markets today, that's $30 trillion.
Jesus. That's what I was going to ask you. How big is that market? If you converted just 10%. 30 trillion.
10% today is 30 trillion.
You think that's real for you? You think you could get there?
We're not going to get there next year, but my point is...
You think it's real, though, in your lifetime?
Yeah, we're going to... 5 or 10% of the credit markets are going to become digital credit.
Okay. Why not? Somebody's going to service it.
Hey, what was the value of real estate before we had mortgages?
A lot less than it is.
Yeah, like if you want the value of a
100x.
home
Yeah.
or
Yeah,
real
right.
estate to go up, you have to build credit on
Yeah,
top
that's
of
right.
it. If banks loan against it, the value of your real estate goes
Yeah.
up. Mortgage-backed securities enhance the market.
What do you think about the 50-year mortgage?
And so the value of
Hang on. What do you think about the 50-year? Because it just came out as a
nice,
proposal. Whatever.
Okay, I'm in favor of giving long duration credit to retail investors.
Yeah.
Right? Like if you could borrow money on a conforming loan for 50 years at whatever, 5-6%, you could turn around and you can buy Bitcoin appreciating 20 to 30% a year.
It's positive. It's good
And
for the
you can do
economy.
it without risk. It's good for you.
It's good for the government. It takes a load off the government.
Yeah. So in any event, I think there's mortgage-backed credit, there's corporate credit, there's sovereign credit. I'm on a mission to commercialize digital credit. You know, if we become 5% of the market, you know, it might take us 20 years.
Trillion.
And by that time, the 300 trillion is 600 trillion.
Yeah.
And the 5%, you know, is 30 trillion. And if we buy if we raise 30 trillion and buy 30 trillion of Bitcoin, Bitcoin's going to be worth 300 trillion dollars, and Bitcoin's going to $15 million a coin. And don't sell your Bitcoin, Grant. And it's going to make your digital real estate business the best real estate business in the history of real estate.
I like this guy pointing at me.
Keep
like
the
that
Bitcoin.
shit's heavy, man. So look, my buddy Ivan Kaufman. Okay, he's a CEO of a publicly traded company. He's a real estate guy. We're good. You good?
Yeah, we're good. Yeah.
And he's like, look. I said, you got to watch Saylor. You got to watch Michael Saylor. I'm trying to get him. I showed him our real estate Bitcoin deal. He's like, Grant, I'll put $50 million in it, take the company public, blah, blah, blah. He's like, but that Michael Saylor guy is fucking greatest salesman I've ever heard in my life. What do you say to the guy that just counts you? And I want you to deliver the message straight to Ivan,
it's like
into that camera.
People
Ivan,
say John D. Rockefeller.
I mean,
was John D. Rockefeller a sales guy, or did he give us unlimited energy and help us win World War I and World War II? And was Henry Ford a sales guy when he said everybody ought to have a car
and, it should be
go?
black.
It's like at the end of the day, if you invent a product that everybody needs that makes
Steve
everybody's
Jobs was a
life
salesman.
makes their life better, the reason that you're an effective sales guy is because you come up with a product that changes the world.
Yeah.
And trust me, I've met a lot of good sales guys selling garbage.
Yeah.
Nobody remembers them as being good sales guys because eventually the product fails.
That's right.
No one's, you know, it's not respecting the population. The billion people that buy stuff are smart enough to know whether the motorcycle works and the plane flies and the car drives. And the reason that people like Starlink is because it works.
Yeah. Do you have Starlink on your plane yet?
Yes, I do.
Yeah. Was it worth doing it?
Yes, it was. It's revolutionary.
Yeah. Yeah.
So look, I mean, technology works. The reason we love AI is not because it was sold to us. It's because you have a complicated problem, you punch it in, and the AI gives you a good answer.
Yeah.
You're like, oh my God, this is actually quite a good answer. And so if the product works, it's easy to be a good sales guy.
Yeah.
And maybe I might say, if your product works and you think you're going to change the lives of a billion people for the better, you get motivated to go sell it.
Yeah, Ivan, listen.
And when you know your product is crappy or garbagey, you know, you're selling an airplane from a kit that's going to kill 1/10 of the people that fly it, you know, deep down in your soul, you don't quite have the same religious fervor because it's not the greatest product. And so
this guy sells $80 billion in debt a year, by the way, on adjustables.
Sell the thing that works, right?
Okay, what happens
not that complicated.
Yeah, no, I love that. Well, and you know I love salespeople too, so selling great products. What happens to, and I see you more as an innovator. I mean, you're a massive disruptor. You're going to disrupt centuries of finance. Anyway, that's my version of you.
Our message is, why would you keep your money in a bank getting 0 or a money market getting 3% after tax when we'll give you triple or
what happens to the banks? We have 4,600 banks in America.
You know,
do we have
10,000 of them went out of business in the 20s, and we still got infinite banks. It's going to go on because it takes a long time to change the world.
Yeah.
You know, we sold 1% of 1% of the Treasury credit in the market. So the biggest IPO of the year was 1 basis point of the market.
Wow.
when Stretch is a $300 billion business and we're a multi-trillion-dollar company, it's going to be 0.5%.
Wow.
And people are going to be like, well, it's still a small part of the market, right? I mean, how big do you have to be to get noticed? You have to be 5%. And when you're 5%, that would make us a $10 trillion company and we'll still be a small new thing.
Yeah.
So I think the banks will go on, the status quo will go on.
Yeah.
This is it's just going to be empowering for the innovators, and it's inspirational to the people that get on board this decade.
The reason I ask is because when I listened to the Bitcoiners, I was down in El Salvador. I went to that deal down there.
Okay.
The maxis. Like I would have got in Bitcoin heavier 4 years ago had the Bitcoiners not talked to me the way they talk to me. Like
they can get kind of toxic at times.
Dude, the world's coming to an end. Fiat's going to go away. The U.S. dollar's going to like that. I'm like, you guys are losing it. What advice would you give Bitcoiners for orange pilling, if you will?
My advice is
they're terrible at it.
Is you don't sell things through hate. You sell them through love. So tell everybody how their life will be improved. I'm going to show you how to make your country better, your bank better, your city better, you have money market, fine, put my product into it. You have a company, fine, put my idea into it. I'm going to show you how to make your product, your service, your country. You have an ideology, you want this kind of diet, I disagree, fund it with Bitcoin. You have that religion, fund it with Bitcoin.
Yeah.
Bitcoin is for everybody. Bitcoin is the universal economic empowerment. If you look at the world today and you think, how many differences of opinions do we have? A lot. How many of the people that bitterly disagree use electricity? All of them.
Yes.
How many people that bitterly disagree on politics drink water?
Right.
All of them. How many people that bitterly disagree agree to use computers?
Find the agreement.
We disagree over the computer.
Right.
And so present this as technology, and don't get drawn into the ideological debates and the political debates. I'm not here to destroy your business. I'm here to make your business better. I'm not here to undermine your ideology. Whatever your ideology, if you think the dolphins should fly and whales, should teleport, and and whatever.
I would like it if the dolphins could just
the
win a
blue
football
demons
game.
Coming down to turn us all into shuffle ducks.
Yeah, that's the turn.
You believe that, but just fund it with Bitcoin, right? I mean, I'm not. We don't have enough time.
Do you think
to try to change people's minds? And Henry Ford didn't try to change your mind. He gave you a car.
He built a car.
You want the car? Buy the car.
Yeah.
And I'm not going to change the politics in Europe or Russia or China or Japan or Brazil or whatever. I'm going to give you a bank account that pays 10%. You're getting 2%. You want it? Maybe you do. You're a bank. If you're threatened by that, my answer is, hey, why don't you just go take Stretch, build it into your bank account, and you offer your customers 8%, keep 2%. I'll power it for you, and you can crush all the other banks. And it's like, okay, you're going to be the first dude with electricity in your factory, I'm just selling electricity.
Yeah, quick round before I leave you, okay? Quick round. I could do another 2 hours with you. What's the longest interview you've ever done, by the way?
Longer than this. I've done 4 hours.
Yeah. Okay.
4 hours. Actually, I did the Breedlove series, and there were days where we went 6 or 8 hours, but we chopped it into 1 hour segments and released it as a bunch.
What happens to Solana?
My opinion on all the proof of stake networks, Solana, BNB, Ethereum, the like is
XRP
is the digital assets economy is bifurcated. There's two sides to it. One side is based on proof of work. It's digital capital. Bitcoin is the king. There's a dozen other proof of work networks. And the killer use case is store of value, digital capital, if you will. Bitcoin is digital gold. And the killer app is digital credit. Dividend-bearing securities backed by digital gold, right? That's that business. That is what I'm in. That's strategy. That's Bitcoin. Now, the other half of the business is digital finance. Digital finance is tokenizing your currency, like stablecoin. tokenizing dollars, tokenizing real world assets, tokenized gold, tokenizing securities like bonds, tokenizing stocks, tokenizing stretch, tokenizing MSTR.
When you say tokenizing, explain, what is a token?
What I mean is
how am I tokenizing it?
When I move stablecoin between, my Android phone and your iPhone on Saturday afternoon, it's Tether. Tether is tokenized dollars. Right, it's the ability to move a token that represents a bar of an ounce of gold, or a dollar bill, or a share of Apple stock.
So I've converted an ounce of gold to,
or Cardone Inc. issues 10 million tokens, and it's like equity in Cardone, or it's some kind of capital fundraiser, or Joe Rogan coin, or Trump meme coin, right? Meme coins, Katy Perry token.
Should I have a token?
It's like, probably, yeah.
Really?
At some point, but say you have a country club membership.
Yeah.
And the membership let's say the membership is transferable. It's more valuable.
Right.
And let's say it's transferable on a token, and you can sell it to anybody. You can post it on a market and let people bid on it in real time, 24/7, 365. Let's say you can take that country club membership and you can tokenize it, put it on a DeFi protocol, and borrow against it and lever it up 10 to 1 and trade it on Saturday afternoon. My point is, like, it becomes more valuable, right?
Yeah, but doesn't somebody get stuck in that deal? Doesn't somebody get screwed? Like when it goes, let's say it's $1, then it goes to 10, then it goes to 100. Some guy in Vietnam said, "Fuck, I'm
not telling you to buy it. I'm just telling you. Asking me what it is."
But somebody does kind of like
someone might lose money.
Yeah.
Somebody else might make money.
Yeah.
By the way, that's the argument for why the country club says we're not going to let you sell your country club membership. And the counter argument is, well, wait a minute. They didn't want me to sell it because they want to censor who gets to come to the country club. And so instead of selling it for $200,000 and making $100,000 and putting my kids through school, I have to give it back for nothing, and they screwed me.
Yeah.
Okay, so my point is, now we're talking about property rights. Should you have the ability to...
I'm with you. You got a good answer for everything. The guy's got more good answers for shit than I've ever come up with. I got to tell you.
Gary Gensler's position was we shouldn't let you sell, raise capital because the investor might get hurt. But then there's 40 million small businesses.
He was the SEC guy, right?
Yeah, he's the chairman of the SEC.
Yeah. The non-accredited investor in America. I just want your take on this. Okay,
Yeah.
I interrupted you again.
Okay,
I apologize.
ahead.
Okay, I am your senior though. And,
it's your podcast.
And so Gary Gensler,
Your fans,
yeah,
your
Gary
audience,
Gensler,
your podcast.
they want to hear you, not me. But Gary Gensler, the SEC guy, he's gone now. He gets involved with a non-accredited investor, says they cannot invest with me because he wants to protect them. He's so worried about this person. But that same person can go spend their last $2,000 on tattoos, in a casino, getting drunk, Visa, MasterCard, buying Gucci's.
The issue is the nanny state. It's like, are you going to tell people how to live their life? And if I run a restaurant and I want to sell 1,000 restaurant memberships and tokenize it, and I want to promise people they get priority seating on the weekend, and I'm going to use it to raise $1 million so I can build my restaurant, it's capital formation. It put me in business. The people that bought it wanted to buy it. I wanted to sell it. And you got some regulator that says, well, it's possible at some point the person won't get their reservation filled and there'll be a disgruntled investor. And so therefore I'm making it illegal for everybody forever. Okay, great. But then like 9,700 restaurants don't get launched because no one can raise money. And so at the end of the day, it's like, where do you draw the line? Am I going to stop you from buying a donut because you might choke on it? Right? I mean, what is the right remedy for selling you a piece of food that's got strep or botulism or it's got food poisoning in it that kills you? Is the right remedy that I take 3 years and 40 million of lawyers to launch a restaurant? Because that's the status quo in securities law right now.
That's right.
Right? And the answer is, like, there's no restaurants. Right? If it takes $40 million in 3 years to launch a restaurant, there are no restaurants. But you admit people do go to restaurants and get drunk, get in the car, drive their car, kill somebody. I think the answer is hold the perpetrator civilly and criminally liable for the damage they do. And
let
Lord
the
knows,
marketplace be
we got enough laws.
Yeah, exactly.
We got enough laws about that. So, yeah, you're right. Something bad might happen. And I'm not telling you to do it or not do it. But what I'm saying is, back to your question, what's going to happen? You asked me what's going to happen with Solana, right? So
Yeah, you're right. Dude,
you want the answer, or you want to talk about the theory of capital formation in the free world,
I want to get it
right?
all done, okay? Solana,
okay.
Ripple, all of them.
And my point is,
yeah, please.
Those proof-of-stake networks, they exist to let you move tokenized currency, tokenized brands, tokenized securities, tokenized real-world assets around. Call it digital finance. It's a vibrant economy. It's fraught with controversy. Look, I couldn't even get through the description without you disagreeing with me about the use case on the network as I tried to pitch it to you.
Yeah.
So there are some people that think that, you ought to be able to issue, digital tokens rapidly, and other people don't think you should. And then there are some people that want to move money at the speed of light, and other people want to KYC it, and they fight over that. And there are some people that want to sell digitized securities to the world, and other people don't want them to travel to Pakistan or the UK. And so you've got an army of lawyers that are debating this stuff. And the bill that's moving through Congress right now, called Clarity Act, is meant to provide some bright lines around what you can do with digital tokens on digital exchanges with these digital finance networks. And right now we're in the gray zone. So, there's a million good ideas, and it could be a multi-trillion-dollar economy, and lots of money will be made. But there's a lot of uncertainty and a lot of questions about, can I actually raise $10 million for my restaurant in 4 hours for $40, or does it take me 2 years? And where does securities law stop, and where does consumer protection begin?
Yeah.
And, I know what I ideologically think should happen, but it's above my pay grade, Grant. The decision will be made.
I don't think a lot's going to be above your pay grade here before
long. The decision is made in D.C.
If you hit that 5%.
There's a negotiation between the House and the Senate and the administration and the industry, and there will be a law, and the law will provide clarity on 70% of these ideas, and there will be obscurity on 30% of the ideas. And, will Solana defeat BNB or Ethereum, or will they all coexist? And it's a technology competition, a regulatory competition, a marketing competition, a stability and a finance competition. And if you're going to be invested in that market, you need to actually spend a lot of time to form an opinion on all those things. I'm not going to tell you who's going to win or lose. Any more than if you were to ask me who wins the AI race. Is it OpenAI or Gemini or whatever? I'd be like, it's all very promising.
Yeah.
Someone's going to win.
Somebody's going to lose.
The world is going to be a better off place with digital finance and digital intelligence. But, at the end of the day, if you want my investment suggestion,
please.
You either buy digital capital in the form of Bitcoin and hold it for 10 years because you trust nobody.
Yeah.
Or you buy digital credit from an issuer that you trust. And if you don't trust anybody, buy Bitcoin, right? If you don't trust anybody and to believe anything and you're the ultimate curmudgeon.
Curmudgeon?
Buy Bitcoin.
What is a curmudgeon?
Curmudgeon. You're just cynical and skeptical on everything and everybody and every new idea.
I know some curmudgeons.
Right. Bitcoin is, the investment of last resort for someone that hates everybody and everything and disbelieves any business idea. You just want to keep your money.
Two more questions.
Yeah.
Okay, you ready?
Last two.
Okay. Where do you have to liquidate? Where do you have to liquidate any MSTR?
I don't think we're liquidating. Look, we have $8 billion of debt. And we have 65 to $70 billion.
$57 billion of equity today.
Yeah. So in terms of Bitcoin would have to fall 90%
from here
for us to be sort of collateralized, to be one-on-one. At which point we probably would dilute the equity, and so it would be bad for the equity.
You would dilute the equity because you would just issue more shares.
We'd have to sell more equity. We're not going to, but the point is we're never going to liquidate. The equity is going to be a loser.
Yeah.
If Bitcoin fell to zero tomorrow forever, then the bonds won't come. The bonds will default.
Yeah.
Right. But a 90% drawdown, we wouldn't default.
Yeah.
Right.
That seems.
So if you think Bitcoin is going to go to 10,000, I think we're good. If you think Bitcoin's going to $1 tomorrow forever, then yeah, the bonds would default. But
Yes, I was in a family
that's
office.
like saying, New York City sinks underneath the ocean. If you think that's happening, your New York City real estate bonds will go bad too.
Yeah. Mogami could do it, though. This Mogami guy. Okay.
Anything can happen. Is that your second question? What's the last question?
No, last question is, what do you think, okay, how do I pull off my real estate Bitcoin fund? What's the right way for me to pull it off? You're Grant Cardone. You're Michael Saylor into Grant Cardone's body.
I have to have a lot of facts to give you an intelligent idea.
Well,
give me all the highlight of the facts.
Got $1 billion of real estate.
Okay.
What do I do? Trophy real estate. You know what I got.
Yeah, it's trophy real estate. Put it together with $500 million to $1 billion worth of equity capital invested in Bitcoin. Wrap the entire thing together and get it public. Find a way to get it public. Take it public if you can. That's the best way.
IPO
Otherwise,
or
do
reverse?
The best is to do the IPO. You control everything yourself. So, I would put the two together and I would IPO it, and that would be that way you're building it the way you want it, and there's no hair and no other.
But if I IPO it, I got to wait on the shelf. So,
when I was. I guess
this is where the lectures.
When I was 27 years old, a bunch of 23-year-old guys that worked for me said, "Mike, we want you to take the company public." I said, "Okay, guys," and 24 months later, I took it public.
Yeah.
If I could figure it out with no money and no experience in my mid-20s, then I think you could figure it out.
Yeah.
It must be possible to take company public. I would do that. There are other ways to get public. You can do a merger, reverse merger, a SPAC, or whatever. But the big idea is bolt on. If you bolt on 500 million of Bitcoin to $1 billion of real estate, by the time you get public, it'll be worth $1 billion, and you'll be 50-50. Yeah. And then you'll have the highest performance, most liquid, most interesting real estate company.
How low you think Bitcoin goes in this cycle right here? If it goes any lower, where does it go?
I think it's pretty stable where it is right now. Yeah. I mean, most of the liquidation selling is out of the system. I think we should rally from here.
And then where do you think it ends?
I don't believe in 4-year cycles anyway. I mean,
I never believed in the 4-year cycle.
I think that they might have had some credence in the first 12 years, but right now, the 4-year cycle is somehow based on the idea that 225 Bitcoin a day get taken out of the supply after the next halving. That's $22 million or $20 million of buying. Trust me, $20 million of buying. The market traded $100 billion yesterday. 20 million is not even a third order issue at this point.
Yeah.
The dynamics in the market are much more that, Jerome Powell thinks he wants to hold interest rates higher for longer, right? It's macroeconomics, it's political, it's structural. When IBIT's derivatives market went from 10 billion to 50 billion, it did that in 4 weeks. I mean, so those kind of things, when JP Morgan, offers 10 or 100 billion dollars of loans against Bitcoin, that will dwarf the 4-year cycle. It's the actions of the mega finance actors that are determining the future of Bitcoin right now. And all the fundamentals are good. So my advice to anybody is, first of all, if you make decisions with a 12-month or less time frame, you're a trader.
Yeah.
If you're a trader, you're a trader. I have zero advice for you.
Right.
I'm not a trader. I'm not a good trader.
Yeah.
I don't purport to be. I have zero advice for you. On the other hand, if you're an entrepreneur or if you're an investor, you should have a time frame of 4 years or longer, 4 to 10 years. And you should have an opinion about digital credit, digital real estate, digital exchanges, digital finance. You should be on a mission to provide, everybody in Africa with something, right? Figure out what is the product or service or what is the thing you're going to do. And if you expect it to pay off in less than 4 years, I don't have any respect for you. Granted, it took me 4 years to get through MIT. Yeah. Everybody gets through college in MIT, 4 years. But the point is, I get it. Your son comes home and says, "Dad, I'm dejected. I'm not going to get a PhD in the next 12 months."
Yeah.
And you're like, "Well, son, you're not supposed to get it that fast.
Right.
If you're not ready to work for 8 years, maybe you're not cut out for a PhD."
Yeah.
And so the average person does 12 years in secondary school, 4 years in college, and they expect their business idea to pay off in 12 weeks.
Yeah.
It's like, get a clue.
Degenerate. Don't be a degenerate.
Nothing.
What message do you have to the degenerates?
My message is digital intelligence, digital assets, and digital capital is going to change the world. And if you want to do something great in the next decade, lock on to one or multiple of those things and figure out how you can, do something unique and make a contribution to the world. And then everything else will work itself out.
Michael Saylor, thank you so much, man. Appreciate your time and appreciate your intelligence. You're deep and very wide intelligence.
Thanks for having me.
Yeah, thanks.